Welcome to Swing Trade Pro 2.0, the 5-step swing trading blueprint. I am Frank Ochoa, president and founder of Pivot Boss and author of the book Secrets of a Pivot Boss. And in this section, we are going to discuss Step 3, Strategy Toolkit. In this section, we will discuss the various option strategies in our strategy toolkit. These strategies are designed to allow you to choose the trading strategy that best fits the risk profile that you are wanting to take for a given opportunity. We are going to discuss various categories of these strategies and give you a very clear approach to engaging these strategies with the various trade sequences that we've already studied in Step 2. So let's go ahead and get started with Step 3, Strategy Toolkit. Before we get going much further, let's talk about the benefits of trading options. In Step 3, Strategy Toolkit, you will learn about the option strategies that we will use in our Strategy Toolkit. You will also learn how to choose the right strategy for the opportunity presenting itself. But first, let's discuss the benefits of trading options. First of all, less capital required. You can trade options using a fraction of the capital required to trade stocks or ETFs, which gives you additional capital to deploy. So again, a lot less capital that you need in order to trade an option strategy. So in essence, you are able to kind of rent that stock or that given instrument using the option as a vehicle to make money as well. There's also less risk involved. The risk is built into the option strategy that you choose, which allows you to define your maximum allowable risk, even if the market were to suffer a catastrophic event like a flash crash. You can't always say that's the case when you're long an actual underlying, because any flash crash will significantly affect those prices. Also, prices can go to zero. You lose the entire investment. In this case, when you're using options, again, you can build in the allowable risk that you want to use at that moment in time, and even if the price of that underlying were to actually go to zero, you're only going to lose the amount of defined risk that you set out at the beginning of that opportunity. So again, less risk, less capital required. The third, potential higher return. So while less capital is required to trade options, they can return nearly 85% of the potential reward versus owning the stock, which means the potential return on investment is oftentimes much higher trading options. For example, you can trade options, say buying calls at $2 or $2.50, and again, that would be for per 100 shares, that would be $250 that you're risking. And if that play again doesn't turn out well, you're only going to lose that $250. You're not going to lose any more than that. But if that opportunity goes in your favor as you expect, you can make many multiples of return on that $250, easily doubling or more the return on investment. So again, that is something that cannot easily be done trading the underlying, but can certainly be done when you're engaging options. There's also more strategies. That's number 4 down here. Options provide a plethora of ways to strategically engage the market, which is a stark contrast to the long-only or short-only approach to stocks. If you want to get into a market, you have to just go long or short if you're going to trade the underlying. But with regards to options, you can do so many more combinations of strategies to engage that market, where you can make money if that market just sits there doing nothing. You can make money if the market goes up a ton or goes up just a little. And you can make max return in some of these cases, even if the market just barely goes in your favor. So we're going to discuss these various strategies and how you can incorporate them into your trading, and also how you can use them with the trade sequences and the day type blueprints that we discussed in Step 2. Now if you look over here to the left, these are the various strategy categories that we are going to engage. Number 1, credit spreads. Number 2, debit spreads, neutral strategies, in the money options, out of the money options, and then trading the underlying. So option strategies for when you are actually trading the underlying. So we're going to go ahead and cover each one of these sections and show you how to engage them, what are the most important points to consider with each of these strategies. So let's go ahead and get started with the first section here. So the strategy toolkit is designed to allow you to choose trading strategies that are categorized by their relative risk profiles, thus allowing you to pick the type of risk that you're willing to take relative to the probability of profit for the opportunity that you are considering. This is very, very important. As you see, 3.1, 3.2, 3.3, 3.4, 3.5, 3.6. This, in my view, is categorized from least risky to most risky. And again, this can be argued in many different ways. This is my approach to it, but for the most part, if you want to take an option strategy that is perhaps the least risky, you're probably going to start with a credit spread of some sort, either a put credit spread, which is bullish, or a call credit spread, which is bearish. We'll talk about what credit spreads are and how to use them in your trading here pretty soon. The next one is debit spreads. This would be the next least likely to be super risky, but it is a little more risky than credit spreads. This is a call spread or a put spread that is actually a debit spread. So instead of a credit spread, you're paying to put this spread on. A call debit spread would be bullish. A put debit spread would be bearish. So again, you have the bullish and bearish counterparts to each of those strategies. Now, neutral strategies would be a little bit more risky. Again, these might actually cost a little more to put on. A long straddle would be a case where you have a neutral market and you're expecting a major breakout one way or another. That would be a long straddle when you're looking for a breakout. Now, when you have a neutral strategy here for a market that's sideways and you think it's going to continue to be sideways, then we can look at our range strategy, which is a short iron butterfly. We'll talk about what that is down the road as well. In the money options would be pretty aggressive. This section right here would be in the money long calls or in the money long puts. This would be a little more aggressive because you're putting more money out there on the line. You are putting premium out there as well, so you're paying premium for this type of opportunity. And then your out of the money options I would put as the most risky in terms of option strategies. And again, this is all personal preference, the way I engage it. You may see others say something differently, but I would call out of the money strategies a little bit more risky because there's no real value in those options at the moment. It's all time value. And so again, if your opportunity doesn't play out the way you think it can, these are the options that may lose the entire premium. So basically, an out of the money option has lower odds of being in the money by the end of expiration, and so they are priced very cheaply. And again, just because they're cheap doesn't mean that they're not risky. They are priced cheaply because the likelihood of them being in the money at expiration is very, very low. On the other hand, these have intrinsic value and time value built into the options, and so they are more expensive, but they have a higher probability of closing in the money. And so this would be less risky than out of the money options. But it would be perhaps more risky than a credit spread because you're putting more money up, whereas you're getting a credit for this type of opportunity. So again, you can see how I've categorized these. Lastly, trading the underlying. I would put this as the most risky only because, again, you are putting much more money into the investment or the trade. You're actually having to come out of pocket to buy the shares, and that costs way more money than just buying calls or a call spread of some sort. So again, this one has more risk because there is more money on the line, but we are going to engage several different option strategies that you can combine with an underlying, a position in the underlying, so that you can reduce risk or protect yourself, etc. So we're talking covered call for income. We're talking protective put for a hedge, and also a collar as a hedge as well. And so we will discuss each and every one of these. By the end of this step, you will know exactly how to engage these markets and these opportunities using these various strategies. So that's how we're going to engage these. We're going to look at these from a least risky to most risky profile, and then that's how you would want to categorize whether you engage a certain market in which way. Are you going to, if the probability of profit for a given opportunity is very, very high, perhaps you can be more aggressive with your trading strategy, choosing something down here, for example. If the probability of profit is good but not great, perhaps you can choose something that's a little less risky, right? And so again, depending on the opportunity itself, is it a great opportunity or is it just a good opportunity? That's going to be the driving force behind which one of these strategies you choose. So look to choose a relatively low risk strategy like a credit or debit spread for an opportunity with good odds of profitability. Choose a more aggressive strategy like in the money long calls or puts when the opportunity has high odds of success. Your ability to determine which trading strategy is right for the setup that you are trading will go a long way toward building consistency. So again, not only will you be trying to tie this to the probability of profit, but also to your level of aggressiveness. How aggressive do you want to be, or how conservative, or how moderate, right? And so again, we talk about putting all of those various factors together in order to build a good approach for the next trade. So let's go ahead and get started with the first section, which is credit spreads. Credit spreads offer a low-risk approach to executing a bias in the market by betting where the market won't go. Credit spreads are an option strategy that pay out a net credit as you are selling a higher priced option and buying a lower priced option for protection. This approach allows you to collect premium on the option sold while limiting your risk with the cheaper bought option. So in terms of a credit spread, this involves selling a higher priced option to collect a premium. So this is you're selling premium basically in this case, while buying a lower price option in the same underlying with the same expiration for risk protection. This results in a net credit for the trade, and so that is a good way to go. Again, that is a low risk opportunity, and basically you're betting again where the market won't go in this case. So there are two types of credit spreads. There's the bullish flavor here and the bearish. The put credit spread is bullish. The call credit spread is bearish. And again, the benefits of credit spreads here, you have defined risk. This strategy allows you to cap your risk for a trade. No matter how the trade turns out, you cannot lose more than your predefined risk. That's fantastic. Again, right here, max profit is easily achieved. In this case, as long as price remains beyond the option that is sold, you will achieve max profit for the trade. In essence, price can go strongly in your favor, mildly in your favor, or even remain flat, and you can still collect max profit with this strategy. That is very, very powerful, and again, that is something that helps you with your overall sense of how the trade might work out. Again, this is something that helps you with mental clarity, because you know that price doesn't have to go gangbusters in your direction in order for you to collect that max credit. And again, this type of strategy does really well with that. Also, time decay works in your favor. That's very, very good, because options, as you may or may not know, options, they basically decay over time. And they can either expire in the money, out of the money. And again, that time decay is something that you really have to be mindful of, especially as the expiration approaches, because as expiration approaches, time decay will accelerate. So again, you want to work with options that are a certain amount of days out in terms of expiration, and we'll talk all about that. Now, when selling options, time decay is helpful. Sometimes, if you're buying options, it's not helpful, depending on how you structure the trade. So when you're selling premium, you want time decay to work in your favor, and it does. So this is the beginning of a credit spread here. Let's go ahead and get started with actual examples. Alright, in this section here, you're going to see that we're going to discuss the credit spreads. Number one, we're first going to discuss the put credit spread, which is bullish, and next we will discuss the call credit spread, which is bearish. So number one here, let's talk about the put credit spread. The objective of a put credit spread is to execute a bullish income strategy for a net credit while also reducing your maximum risk. The sold puts produce the income element, while the bought puts limit your downside risk. In terms of this one, what we're going to see is for each of these strategies, we're going to talk direction, asset legs, when to use it, profit characteristics, loss characteristics, decay characteristics, max risk, and max reward. And each of these will have various combinations of direction, of asset legs, and all these various things. So let's go ahead and discuss this one. The direction for a put credit spread is bullish to neutral. Bullish to neutral. And the asset legs are a short put at a higher strike and a long put at a lower strike. So say you have a $50 strike here and you have a $45 strike here. You could sell the 50 put, sell this put, and then you buy this put right here at 45 just in case price were to tank. In case price tanks, this 45 put basically protects you. It protects your downside. Whereas the 50 put up here, by selling it, you are basically betting that price will close above the 50 put. So as long as price closes at 50.01 or better, you get max credit. You get a max profit on that trade. And so again, that's why you are betting where price won't go. Price won't go below 50, so I'm going to sell that put and collect that premium. However, we're not selling naked. Selling naked would be selling a put or selling a call and then not doing anything against it. That is a recipe for disaster. It may not bite you all the time, but the one time it does bite you, it's going to bite your entire account. I would never ever sell naked there. I always do it in combination with the underlying or with some sort of maximum risk built in. So right here, short put, higher strike, long put, lower strike. Very simple. When to use? You use it if you think the market will go up or sideways. Up or sideways. So what's great about this strategy is that if you sell the 50 put here, you're selling that put, and prices say here, price can go up a little, it can go up a lot, or it could even go sideways, basically, and you can still get that max profit as long as price closes above 50.01 or above 50. And so again, this is why it's so great. You don't have to get a big move in your favor to collect that entire premium. And again, if you think the market will go up or sideways, this is a great way to go. Profit characteristics: you retain the net credit if both options expire worthless. This is the ideal scenario for this trade. You want both of those options to expire worthless. You don't want price to push down and have to really make your lower put come into play. For the most part, you want price to push higher or at least sideways to up so that both of those puts expire worthless and you retain the entire net credit. That is the best way to go, and that is the ideal scenario for this trade. Loss characteristics: the difference in strikes less the net credit you received. So again, if you receive a credit of say 250 and your strike distance is 5 points, so you sold the 50 and you bought the 45, that difference is 5 points. You take 5, you subtract the 250, which is your net credit, and then that gives you what your maximum loss is going to be. And so again, whatever difference in strikes minus the net credit you receive is going to be the maximum loss that you can take. Usually, it's almost going to be a 1-to-1 situation, or maybe you're going to get the loss might be a little higher than what your credit is going to be, but that's the case because this has higher odds of working out in your favor. That's why the payout would be a little lower. Now the decay characteristics: time decay is helpful when the position is winning and harmful when the position is losing. So time decay is in your favor as long as price is in the money, but the longer that price is below the money, the more that time decay hits this position. The max risk is capped, and the max reward is also capped. Again, this is on the least spectrum in terms of risk, and that's why it is, because it's all capped right here. Now, in terms of the strategy and when to use it, use this strategy when you believe price will move higher or at the very least stay flat. Remember, you're selling premium, so you want time decay to work in your favor. Therefore, trade options with 15 days or less to expiration. And so you can basically use a put credit spread and go any length of time in the future. But for me, I like basically putting on a put credit spread somewhere between 10 and 15 days to expiration. And that's usually a good holding period for me. 10 to 15 days to expiration. And again, you want both options to expire worthless. If this happens, you won't have to pay commission to close the position. But if price, say, goes to, the moon here very quickly, then you may not even need to take it all the way to expiration, because at that point, say you got a credit of $2, and then all of a sudden this thing rallies huge over the next few days, that credit will drop down to about a nickel, which is exactly what you want. And if that's the case, in most cases you may want to just go ahead and buy it back for a nickel and go ahead and take those profits, because for the most part you can hold it to the very end and expiration, at which point ideally it goes to 0-0, and now you don't have to do anything to close out the trade and you keep the entire credit. But we've seen many times where this thing rallies significantly and now you're at a nickel. You could have bought it back very cheap, and then all of a sudden you get the big swing move against you, and now you're feeling the heat, and this thing pops back, up to $1 or $2. So take what you can get when it goes in your favor. Now, right here, if the trade hits near max profit early in the trade, go ahead and take the windfall profits at a nickel. Buy it back at a nickel. If the stock rises, both puts expire worthless, and you simply retain the entire net credit. But if the stock falls, then your break even is the higher strike minus the net credit you received. That's your break even point. All right, let's take a look at an actual example now. All right, so right here what you see is an example. Execution. The execution of a put credit spread. Sell the put credit spread when the underline reaches your entry trigger. That's very, very important. This is almost when to do what. When to do what. And when we talked about our trade sequences in step 2, we identified many different areas to enter those trade sequences. There was entry number 1, entry number 2, entry number 3, and in some cases there was 4 and 5 entries, depending on how the thing continues to play out. When the market pulls to your entry trigger, whether it's your first entry or second entry, whichever entry you're looking at, that's when you would sell the put credit spread. So it has to be whenever your opportunity hits your entry trigger, that's when you would sell the put credit spread to receive the credit and initiate the trade. So let's look at a put credit spread example. XYZ is trading at $100 in January, and you believe that price will close above 100 at expiration. So it's trading at 100 right there, and you believe that price will close above 100 by expiration. So what you would do here is sell the put. Sell the 100 put. Because remember, if you buy a put, you are betting that price will go down. If you buy a put, you are betting that price will go down. So if you sell the put, you are basically betting that price will go up and close above the 100. So you sell the put at the money there. At the money, depending on the opportunity, might be around $2.50. Depends on all kinds of variables. Maybe much, much more depending on the price. But let's just say we sold the 100 for $2. Okay. Now we want to buy the 95 for protection. Remember, price is trading up here. We want to buy the 95 put for protection. And because this one is out of the money, it's going to be cheaper. It's going to be cheaper. So say we buy this put for 50 cents. Now we take $2. We subtract the amount that we paid for the protective put here. And now that's $1.50. Our entire credit would then now be $1.50. So if you look here, the net credit transaction is premium sold minus premium bought. You sold the 100 for 2, you bought the 95 for 50 cents. That gives you a total credit of $1.50. All you need now is for price to close any amount above 100, and you collect the entire max credit. If price were to close below 100, then remember your risk is the difference in strikes minus the net credit. Minus the net credit. And so let's take a look here. The maximum risk is the difference in strikes. Right here it's a $5 difference. We took a credit of $1.50 minus $1.50, and so our max risk is $3.50. Now you might be thinking, whoa, why would I risk this to make this? The reason is baked into the cake in terms of odds and probabilities. The odds of this trade working are much, much higher. And so if you have high odds of something being something coming true, you're not going to get paid a lot. It's going to be less reward compared to the risk. Now, if the odds of something are very low of happening, then it'll be, whatever you're using or trading will be much cheaper, and the payoff may be much bigger. But again, the odds aren't likely of that happening. So again, that's why oftentimes when you sell a put credit spread, you're probably going to be getting about a 1-to-1 trade if you're lucky. Sometimes it might be a little less than that, or many times it may be, but you have to know it's because of the odds. The odds of this trader working out are quite good. Now the max reward is going to be the entire net credit you received. That's all you can make out of this trade. That is the maximum amount that you can make out of this trade. And the break-even trade is the higher strike minus the net credit. So 100 minus 150 gives you 98.5. So that's why I mean that price can go up a ton and you'll make the net credit. So if this is 100, price can go up a little. Price can go up not at all, just 1 penny, and you can make the entire net credit, right? Now price can actually even go down as far as 98.50 and you would still be making money. Maybe not the entire 150, but you could still make money, theoretically speaking, as long as price closes above 98.50. So it could even go against you and you can still make money. And that's why I like this strategy, especially for those of you that may not have a whole lot of options experience, or for those of you that may not be very good at pinpointing your entries and pinpointing that trade location with minimal adverse excursion. Now, because you've studied step 2, trade sequences of Swing Trade Pro 2.0, you're going to have phenomenal accuracy in terms of where your trade location is. We know exactly what we're looking for, and you will know exactly when and where you want to engage those trades. So you're going to have much more accuracy in terms of identifying those zones. But the same is true even if the market doesn't play out as you expect. Even if it's a little up, or maybe not up at all, or even a little down, you can still make money with this approach. And that's why I love put credit spreads and even call credit spreads. Now, right down here, look to cover this trade ahead of expiration to avoid assignment if the position is losing. That is very, very important. For all of these strategies, I'm looking to take a swing trade. This is Swing Trade Pro. I'm looking for price to push in my favor, and then I'm looking to get out of Dodge with my profits and be done with it. I'm not usually looking for price to complete all the way to expiration on these option strategies. I don't need to hold that trade all the way to expiration unless it's a put credit spread that's way in the money, right? But for the most part, if any of these strategies are losing money, most of the time, especially if you sell, if you're selling premium, to avoid assignment, get out of that trade early. And again, as we know, especially with a lot of those trade sequences that we're looking at, those rejection day trade sequences near the midpoint, if you take a trade when it's here at the midpoint and 2 or 3 days later now price is closing below that midpoint, that's your chance to go ahead and get out of that put credit spread or any of these strategies, right? We're not holding to expiration, and you want to avoid possible assignment in the cases where you have sold premium. All right, let's take a look at this trade here. This is Wynn Resorts. Again, this is one of the ones that I traded here when we had a major rejection day off the 160 level, major level. We've talked about this in the trade sequences section. And one thing about this here is, again, many different ways to engage it. So what we're going to do with all of these strategies is we're going to have the same example, and then you're going to see the various strategies applied on that same example for the long side, and then you're going to see the same thing for the same example on the downside. So this is the long side example, is our win resorts trade. Remember, a put credit spread is bullish, and the objective of a put credit spread is to execute a bullish income strategy for a net credit while also reducing your maximum risk. The sold puts produce the income element, while the bought puts limit the downside risk. So this is 160. Remember, we had a major rejection at that level. A major rejection. Price drops down significantly, drops as low as 156.54, but by the end of the day is back at 162.98. That's a major reversal, a major rejection of prices below 160. And at the very least, we're looking for price to push higher toward 170. So, if we believe that price is going to push higher, we can then look to sell a put and buy a put for protection. So remember, the execution of this strategy is sell the higher put and buy the lower put for protection. And you have to do it for the same expiration, right? And again, whenever you do this, all you need is for price to close above 160 and you retain max credit. Now remember, this is a 5-point spread here, 160 versus 155, 5-point spread. The credit here that you're going to receive for this is 206. So you're selling the put for 241. You're going to buy the 155 put for 35 cents because remember, it's way out of the money. Here it is right here. Price is way up here. That's why it's so cheap. So again, it gives you a net credit of 206. So you take 160 minus 206, and that gives you a break even of 157.94. Now here's what's important. Remember, with this type of strategy, price can do this, it can do that, it can even go this way, and it can even go down like this, and you can still make money. You can still make money. Now ideally, I want price to close above 160. Take the max credit and be done with it. And even in the most ideal situations, I guess, if price pops higher in your favor really quickly, go ahead and buy it back for a nickel, and you've made most of that credit, and now you can move on to the next opportunity. So again, 160 put you're selling, you buy the 155, you take the difference of those and subtract the credit you received, and that's your break even. So here are some tips. Sell when implied volatility is high, because that will lead to higher premiums. So when you have high implied volatility, the options premiums are also high. In this case, premiums were very high in here when we had a lot of major volatility due to the news associated with this stock. Over here, things had quieted down a little bit, but again, a major day here pumped up some of this a little bit. But again, you definitely want to sell when implied volatility is high. In my case, I'd prefer to sell with 15 days or less to expiration. You can use weekly options. You can use monthly options for this case. But again, I like 15 days or less to expiration. Time decay works in your favor even if price doesn't move. And also, if price closes above the sold put at expiration, allow the position to expire worthless to collect max credit and to avoid paying commission on the exit. That's just another way to squeeze out a little bit more efficiency. So if you are very, very confident that price will close above that 160 at expiration, go ahead and let it expire worthless, and then you won't have to pay anything on the back end of that trade. And again, that may seem like a small savings, but when you add this up over time, over all of the trades that you will do, saving that little bit of commission over time, especially as your account grows, you trade larger size, that's going to be a big savings at the end. So again, any little bit that you can save squeezes out a little extra efficiency, and that adds to the bottom line of your account. All right, this is what it looks like right here after price bounces and expires. So we had this one here. This is the entry right there. When price opens the next day and drops into the 160 put, that could be when you sell the put credit spread. Again, you had a net credit of 206. When price jumps up significantly, very quickly, even as soon as here or maybe even here, it's already at a nickel or maybe even less, maybe at 0.01 or something like that. Again, you can take it off right there and go ahead and take that. Or if you believe that price will close above, you let it expire worthless. As long as price closes above that 160 at expiration, this trade will make a max profit, which is 206. Now, with put credit spreads, again, they're very trader friendly, as price can move up, sideways, or even mostly against the sold put, or modestly against the sold put, and still finish with a max profit or a break-even trade. You want to execute this with 15 days or less to expiration, and preferably after a significant rejection. Now here are a couple tips. Allow the options to expire worthless to collect max credit and to avoid paying commission on the exit. And should a windfall occur early in the trade, consider buying back the spread ahead of expiration for a nickel. Now again, this one turned out very, very nice. This is the expiration here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 days. And that's it. Again, 10 to 15 days is a great amount. You could even do it, less than that. 8 days, 2 days. I've sold a put credit spread 1 day left to expiration and made a great amount of money because it was BABA. So you can sell anything. And again, anything less than 15 days is usually a sweet spot for me. Every opportunity is different. But you can, again, sell with 1 day to expiration and still make a great profit depending on the opportunity at hand. So a great one right here. Again, very clear example. This is a rejection day trade sequence where you have a major rejection day at an LVN at multi-month lows. You have a midpoint retest. You have a major continuation day here. You have the retest after stop run, and then you have continuation legs. This is a great trade sequence here with a perfect entry point, and again, flawless little trade. All right, let's talk call credit spreads now. A call credit spread is a bearish option strategy. It is the bearish counterpart to the bullish put credit spread. The objective of the call credit spread is to execute a bearish income strategy for a net credit while also reducing your maximum risk. The sold calls produce the income element while the bought calls limit your upside risk. Direction? This one is bearish to neutral. Remember, if you are selling, say, the 50 call, you are betting that price will close below that 50 call. So you sell it and collect the premium. The asset legs are a short call. That's the lower strike. And then you also buy a long call as well at a higher strike. So say you buy the 55 call up here for protection. Just in case price were to do that, you cover your backside here with a 55 call. But for the most part, that one's going to be the cheaper option because it is out of the money. And so you sell the actual call down below, you buy the cheaper call up above, and that gives you a net credit. And you will retain the net credit if price basically closes below that 50 strike or the sold strike that you sold. And again, the goal is for both options to expire worthless. This is the ideal scenario. Again, with this scenario, you can have price go sideways, a little down, or way down, and you can still make money. As a matter of fact, it can go against your sold call and still make money up to the break-even point. So again, it's a very, very powerful strategy, especially for those of you that are still working on consistency. For those of you perhaps that are still having trouble finding trade location, right? So again, this is a very forgiving strategy to use, and that's why it's at the top end of our risk profile here, right? the top end, because these are the least risky strategies, at least the way that I use them in my trading. And the farther we go down the list, the more risky these strategies go. So again, this is a great strategy, put credit spread and a call credit spread, for those of you that are still working on consistency. Now here, the loss characteristics will be the difference in strikes less the net credit. The decay characteristics, or the time decay, is helpful when the position is winning and harmful when it is losing. Again, your risk is capped and your reward is also capped, which is very good, again, for those of you who are still working toward more consistency. Strategy: use this strategy when you believe price will move lower or at the very least stay flat. You're selling premium, so you want time decay to work in your favor. Therefore, you want to trade options with 15 days or less to expiration. Again, if you look at a typical time decay chart, it does something like this over time. And so, for example, the last, say, 20 days to expiration, you're going to get a major drop. The last 10 days to expiration, time decay really kicks in. Whereas it's a little slower over here, 30 days out, 40 days out, the curve is a little slower. But once you get to about 20 days, boom, it really drops. 10 days, and then all of a sudden, time decay really works aggressively. So we're using time decay to our advantage, because if we're selling premium and you're selling with 15 days or less, then that right there helps, because time decay will be accelerating rapidly at that point. Over here, you want both options to expire worthless. If this happens, you won't have to pay commissions to close the trade. If the trade hits near max profit early in the trade, go ahead and take the windfall profits. Again, if price tanks after you sell that 50 call, then it's probably going to be worth somewhere between 1 and 5 cents at that time. And so you can go ahead and take that off the table somewhere around there and just be done with it. Again, if the odds are very good that it's going to stay down there until expiration, then you can go ahead and just let it expire worthless. But in most cases, if you get the windfall profit quickly, might as well take it. Now, if the stock falls, both calls expire worthless and you simply retain the net credit. And if the stock rises, then your break even is the lower strike plus the net credit you received. Let's take a look here at an example. So here's an example of a call credit spread. Number one, the execution: you want to sell the call credit spread when the underlying reaches your entry trigger. Again, we would be looking at, say, for example, a bearish rejection day trade sequence, and we're looking for a midpoint retest perhaps. Whenever price comes back to the midpoint retest, this would be the point where you would want to sell that call credit spread. Now, in terms of the example here, XYZ is trading at 100 in January, and you believe that price will close below 100 at expiration. Again, it's a simple true-false. You don't have to guess how far it's going to go. You just true-false, above or below 100. Okay, I think it's going to close below 100. Well, let's sell the 100 call then. Let's collect $2 premium. But just to be safe, let's also buy the 105 call out of the money for cheap, and then let's give ourselves a $1.50 credit there. So that's a way to go. Now, the net credit, premium sold minus the premium bought. Sold this, bought that, comes out to a $1.50 credit. The max risk is now the difference in strikes minus the net credit. So difference in strikes, 105, 100, that's a $5 difference, minus 150 gives you $3.50. So your max risk is going to be $3.50 here. The net credit received is $1.50. That's your max reward. You can make no more than the net credit that you have received in this scenario. And the break even is going to be the lower strike plus the net credit. So the lower strike would be 100. You received $1.50 for the net credit. That gives you $101.50. So that's your break even price. So again, here's your 100 call right here. You sell that one, right? You sell it. Boom. But if price were to turn around, it can go as high as 101.50 and you could still be in the money. It could close at, say, 101 and you would still make $1. Instead of the $1.50, you'd make $1 if it closed at 101. So pretty powerful the way that is. Now let's take a look here at the collect one premium, $1.50 in premium, which stays in your account if price closes 100 expiration. Now if price remains below 100, allow the options to expire worthless to keep the entire credit and to avoid paying commissions. If price goes against the trade, the break-even point is the lower strike plus the net credit received, and look to cover this trade ahead of expiration to avoid assignment if the position is losing. So again, while you do have protection here with the 105, if price starts losing here, again, I'm usually looking to take that off the table and not really hold it to expiration. But again, even if you forget about the trade or whatever happens, you're covered at expiration by the way that you structured that call spread. But for the most part, look to get out of the trade if your failure point in the trade sequence is violated. Alright, this is Halliburton. And Halliburton saw major resistance at the $46 level. 46 is right here, a big time key level, and look at how many times price rejected and rejected and rejected and rejected off that level. And now recently here, price rallies back to that level and throws off a bearish rejection tail there, right? That is your rejection day blueprint. And that rejection day type suggests that we were likely going to return back down toward value. Now again, if 46s have been offered time and time again, we could theoretically sell the 45 call just below and buy the 46 call for protection. And in this case, by selling the 45 call, which is slightly out of the money, and buying the 46 call, you would basically get a credit here. 60 cents for selling the call, 10 cents for buying. That's a 50-cent credit. Right now, your max risk is 50 cents, your max reward is 50 cents, and your break even is going to be 45 plus the credit, which is 45.50. So again, in this case right here, we're betting that price will close below the 45 call. But even if it weren't to close, maybe it closes at 45.25, we would still make money up to 45.50. And if price were to rally through here, the 46 call protects us. So again, that's the structure of a call credit spread. You want to short the call at the lower strike, long the call at the higher strike with the same expiration. And you sell the call credit spread when the underlying reaches your entry trigger. This right here is our rejection day sequence. Your entry trigger is going to be around 45 bucks, 45 and a half. So if price opens the next day and rallies, this is about the point where you would want to sell the credit spread in most cases. Now the tips for this one: sell when implied volatility is high, sell with 15 days or less to expiration. Your time decay works in your favor even if price doesn't move, and if price closes below the sold call at expiration, allow the position to expire worthless to collect max credit and to avoid paying commission on the exit. Let's see how this one plays out. Now again, this is another one we saw in the trading room. We had great levels in here. We had this one long all the way into 46, and then right around here, this was our initial entry for a sell. Boom, back down, and then it happened again and again. Look at the midpoint retest right there. That is your entry. That's the entry, right? So in most cases, this is going to be your absorption zone, as we noted in step 2, trade sequences. So when price opens below that zone and rallies into it, that's the best spot to initiate your bearish trade. And in this case, using the call credit spread, we can then sell the 45, buy the 46, and see what happens. And when price drops all the way down, again, a huge drop. You could have made much more money with a different approach, but you never know how the market's going to play out. This is a very safe approach, and that's why it's the least risky approach to trading, a directional bet. In this case, as long as price closes down here, you can let that trade expire worthless, and you will collect the entire credit, and you won't have to pay any commissions on the exit. Now, say for example, price immediately drops, boom, like this, but you still have, say, 5 days left to expiration, and you're sitting at, say, a nickel of value. You don't have to let price go all the way to the expiration, because now there's more risk involved. Might as well take it off for a nickel. And as a matter of fact, what I would caution is to basically, anytime price does fall in your favor, do not, especially significantly, don't get complacent here, because price can come back every time. It can and will. Just look here. I mean, when bears got short here, it dropped all the way back to these levels. You could feel like a king or queen here. Feel like the smartest person ever, and you're holding on because you're greedy, and then look at it come all the way back and take out the high. It can and does happen. It will happen to you if you let it. And so what I would say is, if you enter and trigger a trade, any of these trades, but especially a call credit spread and especially a put credit spread, if you're going to sell premium here, as soon as you are filled, put in your exit ticket for a nickel to buy it back at a nickel. And so as soon as it drops significantly, you can be taking that off for a nickel and be good with it. And so again, maybe you won't be letting it go to expiration if you put it in for a nickel, but it's uncanny how quickly you can grab that sometimes, and then all of a sudden price can be all the way back, and so you'll be happy when you did. Now that we've covered credit spreads, it's time to move on to debit spreads. A credit spread is so named because you are receiving a credit when you sell premium. A debit spread, on the other hand, is when you pay to put on a position. Debit spreads offer a risk-defying approach to executing a directional bias in the market. Debit spreads are an option strategy that results in a net debit, as you are buying a higher price option and selling a lower priced option in order to offset time decay, limit risk, and reduce the cost basis of the trade. So you can see right here, we've moved on now from the least risky credit spreads to the second least risky, which is debit spreads. First one we'll talk about is the call debit spread. The second one will be the put debit spread. One's bullish and one is bearish. So debit spreads involves buying a higher priced option while selling a lower priced option in the same underlying with the same expiration, and this offsets the effect of time decay, reduces costs, and that results in a net debit for the trade. The two we're looking at, call debit and put debit, bullish and bearish. So for the call debit spread, again using the 50 strike here, you would buy this call, the 50 call, and then the 55 call is the one you would sell. So you're buying, you're betting that price will go higher, and so you're buying the 50 call. But then you're going to sell the 55 call to collect a little premium on that one and reduce your cost of the overall trade. It's also, by selling this call, going to offset the effects of time decay. So what if you buy this 50 call right here and price doesn't go quickly in your favor, instead it goes sideways a little bit first? Well, if you had just bought the 50 call going sideways, you're going to get hit with time decay. But by selling the 55 call in addition to buying that 50 put, this right here helps offset that time decay. It also reduces the overall cost of the trade, which is very important when you're dealing with high priced flyers like Amazon, for example. Amazon, if it's trading up here right now somewhere around $2,000 a share, when you're buying an at the money call, can cost you 20 something dollars. And if you're buying an in the money call, it could be, $80. That's very, very expensive compared to normal. So selling a higher price call against it helps reduce rather that price, that cost that you're paying for that spread. Now here's what I really love about these spreads: defined risk. So this strategy allows you to cap your risk for a trade. No matter how the trade turns out, you cannot lose more than the amount you paid for the trade. So if you bought a spread for, say, $2, that's the most you can lose. If you buy a spread for, say, $5.10, that is the most you can lose. You cannot lose more than that amount. And that, again, is very, very powerful, especially for those of you who are continuing to work on consistency, for those of you who may be fearful of losing money, which is not a great mindset, but you have to do something in order to remove that fear from your brain. And this is one way to do that, because you are defining your risk and you know that you cannot lose any more than that. Yes, you can put a stop in a stock or a futures contract if you're long the underlying, but that stop isn't guaranteed to work if there's a flash crash or some sort of aggressive event. This option strategy is and will work. It will work when you have that flash crash event. You cannot lose more than that. So again, it's very calming for the trading mind to understand that, because now you can just put these positions on and let them do what they may, right? And again, you're not fearful that you're going to lose a significant chunk of money because you have built in the defined risk into that strategy. Time decay is offset. I love that. Again, time decay can be very ugly, especially toward the end of expiration. And so by selling those calls against it, or selling those puts against it, the initial bought call or put, that's going to basically offset the negative effects of time decay. This, by selling that call or put, also you're lowering your cost basis, which is very important. So by selling the lower priced option, you are reducing the cost basis of the trade while also improving your break-even point. All right, let's take a look at debit spreads. The call debit spread is a very powerful spread because, again, you build in your max risk. You reduce your overall cost for getting long. So again, if you have a smaller account, buying just a call, for example, can be a little more expensive. And also, your break-even will be a little higher. But by doing a call debit spread, you're going to reduce your cost of that trade, which allows folks with smaller accounts to really participate. And you're also going to cap your max risk as well. Now, this trade also has a capped max reward. So again, you're not going to make a huge upside if price rallies significantly in your favor through your sold call, for example. You're only going to make whatever amount that you've already built into that trade. We'll talk about that here as we get into the next slide. But right now, the objective of a call debit spread is to execute a bullish trade by buying calls while reducing your maximum risk by selling calls at a higher strike. The sold calls cap potential profit, but also reduce your cost basis, risk, and break-even points. So this is a bullish trade. It's not a bullish to sideways, it's a bullish trade. You want it to go higher. The asset legs are a long call at the lower strike and a short call at the higher strike. When you use this option, you want the market to go up, but you don't think it's going to go up significantly. You might think it's going to go up, but you don't think it's going to go up quickly. It might take its time to go up, it might do its thing, and it might go capped here. And that's why we use this approach, because by selling the higher call, you are offsetting time decay in case that it takes a little longer to get to that target. Additionally, though, you are capping your upside, because what if this thing really shoots through those highs and you sold this call? Well, you're not going to partake in any of those gains. You're only going to get up to the amount that you built into that trade. So again, this is not a super aggressive approach. This is an approach that you would use if you think a market has limited upside and perhaps may take a little while to get to its target. If you think the market's going to do that, then I would point you somewhere over here in terms of being able to capitalize on that move a little more. This is more of a risk-averse strategy that allows you to offset the negative effects of time decay while also improving your cost basis and break-even points. So when do you use it? when the market's going to go up but has limited upside. The profit potential here, the max profit is reached if price closes at or above the sold call at expiration, and this is the ideal scenario. The loss characteristics, the max risk is the net cost of the spread, and that's it. So again, if you paid $5 for the spread, that's your max risk. You paid $5, and now you're either going to make money on that, or you can lose a portion of that or all of that. But you can't lose more than that. Time decay is helpful when the position is winning and harmful when the position is losing. And again, max risk and reward are both capped. Strategy. Use this strategy when you believe price will move higher but has limited upside. If the stock rises to the higher sold call, you make max profit at expiration. If the stock falls below the lower bought call, you take a max loss. And if the stock falls somewhere in between, then you must clear the break-even point, which is the lower strike plus the net debit. Let's take a look at a paper example here. This is a great example. Very, very clear and easy. Execution by the call debit spread when the underlying reaches your entry trigger. Again, if you have a rejection day trade sequence, in most cases, this midpoint will be your entry. So if price pulls back to that entry, this is when you would execute that call debit spread. You would buy it when it hits that point. XYZ is trading at 100 in January, and you believe that price will rally, but it has limited upside to about 105, you think. So in most cases, when I put on a spread, I want to put on the spread at the level that was rejected. So say the level being rejected is 100. And then if I believe that price will rally to, say, as high as 105, that's my target based off of, say, average monthly range or average daily range, then whatever the target is, that's the strike that I would look to sell. So I bought here, I sell this one. And so whenever price pulls back to the absorption zone, where your best trade location is, that's where you would execute that strategy. Ideally, price would continue higher, and now you wait for this thing to approach your target as long as market structure remains intact. Now for the 100 call here, you're basically going to buy this one for $2. Up here, this one's way out of the money, so you're going to sell that one for 50 cents. And the net here is going to be $1.50 net. So that's the cost of your trade. The cost is just $1.50. Instead of it being $2, you reduce the cost to $1.50 because you sold the 105 call. Again, you're reducing your cost basis. You're basically negating the negative effects there, or offsetting the negative effects of time decay. So there's a lot of good things for selling this higher call, but you're also capping your upside. So if price were to shoot through 105s and close at 115, you're only going to make the spread between 100 and 105 minus your debit. You're not going to make all the money up to 115. So again, if you think price is going to rally to 115, put the spread and sell the 115 instead, or try one of these other options to take advantage of that aggressive move instead of doing a spread. But if you have limited upside, if you think maybe it might take a little while to get to that target, a spread is a great way to go. So your net debit transaction is the premium bought minus the premium sold. $2 versus 50 cents gives you $1.50. That now becomes your max risk. You cannot lose more than $1.50. The max reward is the difference in strikes minus the debit paid. 105 versus 100, that's 5 points, minus the $1.50 gives you $3.50. That is your maximum reward. So if you're looking at a 5-point, basically a 5-point spread between your strikes, then you want to pay as little as possible for that 5-point spread so you can make more of the profit. In most cases, if you're paying 33% of the proposed spread, it's usually a pretty good value at that point. That's just a general rule of thumb. So on a 5-point spread, if you pay about $1.67, that's a pretty good amount for that spread. If you have, say, a 15-point spread, paying $5 is a pretty good amount. If you have a 10-point spread, paying about $3.33 is a good amount. That's about a good general rule of thumb. And now you have, 66% upside on your on that trade, and 33% is the amount paid. So again, that's just a good general rule of thumb. Your break even is going to be the lower strike plus the net debit. So 100 plus the amount you paid, that means your break even is 101.50. So at expiration, you need to be beyond 101.50 at expiration. Now again, with a call debit spread, I'm not looking to hold it to expiration. I can and do hold the put credit spreads, the call credit spreads. So the credit spreads I can hold to expiration. But on a debit spread, I'm not looking to hold anything else to expiration for the most part from here on out. These debit spreads here, the neutral strategies, the in-the-money options, the out-of-the-money options, I am generally not looking to hold any of these to expiration. I am looking for a swing move. I'm looking for a quick move in my direction, in my favorite direction, and then I'm looking to take that off wherever I can. And so again, only the credit spreads would I hold to expiration in most cases. Anything else, I am not looking to hold it to expiration unless it's a special circumstance. For the most part, I am renting these strategies, and if price were to rally in my direction, I am taking the money and I am running. And that's my goal each and every time. So keep that in mind. So max profit occurs if price rises to the higher sold strike. If price closes below the lower bought strike at expiration, you take a max loss. And if price closes somewhere between the two strikes, again, your break even is the lower strike plus the net debit paid. Let's see what this looks like on a chart. Again, here's our familiar example in Wynn Resorts. A great rejection off the 160. Again, that's also our proposed entry point. What we're looking to do right here is buy the 160 call and sell the 170 call. And what I usually do is start to line this up at the end of this day. So at the end of this day, in the last hour of this day, you see a major rejection here developing. That's an automated signal right there, just like this is automated, just like these are automated over here. These are automated. They are designed to bring these opportunities to my attention. And when you see that this is formed in the last hour of the day, I start calculating, okay, I'd love to buy this call because I think price will close above it. And I'd like to target 170 because it's right inside my high probability target zone. From this low, we can forecast this target range based on average monthly range over the last 10 months. It gives us a high probability target range to watch for. So buy the call here, sell the call here, but you have to wait for price to open the next day and drop into your absorption zone, and then you place the trade. So in this case, when that happens the next day, the call is worth $3.59 when price is at the 160 on that day. You sell the 170 up here for 55 cents. 55 cents. That means you have a net debit of 3.04. This is now your max risk. That's your max risk. This is a 10-point spread, 160 to 170, 10 points minus 3.04. That gives you 694 as your the amount of money that you can make in total. That is your max risk right there. And so, or max reward rather. And so again, the cheaper you buy the spread, the bigger the reward. Because had you bought here at the end of the day, well, this was $3 in the money off the 160. And so if it's $3 in the money, it's going to be much more expensive. You would not be buying at $3.59. you might be buying at $6.59 because it's $3 higher. And so that's why you have to be patient and buy at around the right time. So again, 33% of a range of a spread is usually about what I go with. Generally speaking, I'm not super hard and fast on that, but I do want somewhere around there. In this case, 304 is less than 333, and that's a good trade. And now you have 66% upside here in that scenario. Again, with this type of opportunity, you want to buy when implied volatility is generally low. You generally want to buy when implied volatility is low because you're not selling premium like with the credit spreads. When you're selling premium, you want volatility to be high because now those premium prices are going to be higher and you can sell them for higher prices. But when you're buying, because this is a debit spread, you're buying it and it's debiting money from your account to buy the spread, then you want volatility to be generally low. And if implied volatility is generally low, the prices will be lower for what you're paying. You also want to buy with 30 to 50 days to expiration in most cases for how I engage the market. Many of our trades that we're looking at here in Swing Trade Pro 2.0, the trade sequences give you trades that can take anywhere between 5 and 15 days to reach their targets. I'm usually looking at somewhere between 1 to 3 weeks in trade. And so with 1 to 3 weeks, 5 to 15 days, sometimes a max 20 days in trade, but usually I'm never in trade that long. I'm usually max in trade 3 weeks, right? And most times I'm in and out within 5 to 7 days, 5 to 10 days, right? So it's 1, 2, 3 weeks in trade on a swing basis. And so if we're looking at, say, up to 3 weeks of in trade, then you want to have enough days to expiration in order to not start getting hit with that time decay. Because remember, once you start getting to about 20 days to expiration and then 10 days to expiration, you start to see time decay really drop, the time value of these options. So I generally like 30 to 50 days. 45 is a great sweet spot. And then after your 15 days in trade, you can sell that off for 30 days and there's still enough time value and everything left in it. So again, that's usually how I go. Now, every opportunity is different. Every opportunity is different. If you were very, very aggressive here and you really believed that we would be here in a matter of a day or two, you could have used weekly options, with 5 days to expiration, and you would get much more benefit out of that trade. But you also have much less room for error in that case. You really need to be right, or again, that time decay will eat you alive. So again, 30 to 50 days is a very good amount of days to expiration. If you start getting over 50 days, in my opinion, that type of trade can become a little too expensive because you have much more time value built into that trade. So again, there's a sweet spot here that we're trying to work with. Now in terms of time decay here, it is offset mostly here with the sold call because you sold that 170. That helps to offset the time decay. Look to exit the position ahead of expiration, typically once your profit objective has been reached. Again, I'm not looking to hold these positions all the way to expiration, especially if they're losing. If they're losing, I don't want anything to do with them, and I'm usually pretty short with them. I don't have a whole lot of patience for something that isn't working out. In most cases, our trade sequences are so powerful, they should start to make money within the first 3 to 5 days. Or at least stay holding above the absorption zone. Any break below the absorption zone likely does that trade in, and you don't want to be any part of that anymore at that point. So again, look to exit that trade as soon as price hits your target. So as soon as this thing rallies into the zone, I'm good to go to take that off and be done with that trade, chalk it up as a win, and then move on to the next one. As we know, win popped up pretty strong. From the put credit spread, you know that win closed somewhere up here. 10 days later, it was somewhere up here, right? But Again, I wasn't looking to hold to expiration in this idea. With this one, when I entered the trade here, I actually bought the 160 and sold the 170. So this was one that I actually traded as well. In this case, price moved higher very nicely 2-3 days later, and then a big gap up occurs above the 170. Big gap occurs above the 170. Remember, we sold the 170. And so everything beyond this level here, we're capped in terms of our upside because we sold the 170. So this is one of those scenarios where I capped my upside. I was being a little more cautious because of the allegations against Steve Wynn in this general area. I did still believe strongly that this was a great rejection, and despite the allegations, I thought we could get a great bounce. But I capped the upside just in case. I just wanted to be a little bit more risk averse in this scenario, just in case, because you never know if more allegations would come out or what the case might be. And so this is one of those scenarios where I capped my upside, but as soon as price gaps above 170, it makes me happy. I completed the trade. You take your money and you're good to go. So in this case, the price is now beyond the 170 strike, which is the call you sold, and reached the forecasted target zone. This is when you look to take profits. And again, this is that morning. This is not a completed bar. This is what it looks like that morning when it gapped up, traded down, traded up, and it's hanging around up there. And I'm like, hey, this is a good time to take those profits and walk away. And let's look at what that looks like on paper. Remember, the cost of the spread on March 2nd, 11 days to expiration, was 304. And then the cost of the spread on March 8th, 7 days to expiration, was 823. So when price popped up here, it was 823. You take your 823, subtract the 304 that you paid for the trade, and you come away with a gain of 519. That's a gain of 171% on your original investment. And that's why I mentioned before that options can give you a higher return on your investment in many cases. And you're also using less money to put up to front that trade. Remember, one options contract is equal to 100 shares of stock or of the underlying. And so you would subtract 100 times 3, and you get $304 was the cost of that trade for one contract. For one contract, which represents 100 shares of stock. And so you end up making $519, again, times 100 equals $519. So you spent $304 to make $519, 1, 2, 3, 4 days, and that's all it took to make 171% on your money. Now, again, this trade right here is capped in terms of risk. You can only lose the 304. So say you trade 10 contracts. You now are risking $3,000 to make as much as, what was it, nearly 700, 696 or whatever it was, something like that. And that would be times 10. Again, you could be looking to make this amount while risking only this amount. And because, again, we took profits early and not at expiration, you're not making the entire amount. You're getting a little bit less because, again, you're not there just yet. You still have time value here and all that. So again, you can make much more return on your money with an approach like this. And again, if you scale this up, say you can trade 2 contracts or 5 contracts or 10 contracts or more, you can scale and still be risk averse because you're calculating your max risk, your max reward, and you're happy with that amount. And again, that's the way to engage this zone. So tips: look to take profits ahead of expiration once price hits your forecasted target zone. Remember, I'm not looking to hold this trade to expiration. I just want to rent the stock by using the options, and as soon as price hits my target zone, I take it out and I move on to the next one. Okay, in debit spreads, we're now going to look at the put debit spread. This is the bearish counterpart to the call debit spread, which we just covered a moment ago. In this scenario, what we're looking for is for to buy a put debit spread to execute a bearish trade by buying puts but reducing our maximum risk by selling puts at a lower strike. The sold puts cap profit potential but also reduce your cost basis, your risk, and your break-even points. Right here, again, direction is bearish. So a put debit spread, remember puts, you're betting that this thing is going down if you buy them. And since this is a debit, we're buying it. So this is a bearish strategy. The asset legs, you're long a put, which is the higher strike, and you're short a put, which is the lower strike. So say you're buying the 100 put because you think price will push downward below 100. But you think there might be limited downside, so you sell the 95 put. By selling this put, again, you're reducing your cost basis. Because if you buy this one for, say, $2 and you sell this one for, say, 50 cents, well, now you've reduced your cost basis to $1.50. Right? And again, by doing that, you're reducing your break-even point as well. A lot of good things, but you're also capping your upside. That's the biggest one. You're capping your upside. So when do you use it? You use it if you think the market will go down but has limited downside potential. So if you think the market will go down but may go down slowly toward its target or may not go down too far, then this is a great approach to take, the put debit spread. If you think the market's going to fall off the face of the earth and dig a hole through to China on the other side here, then that's a case where you might want to be a little bit more aggressive with in the money puts or out of the money puts. This is a case where we think there's limited downside, or perhaps price may take its time to get to our target, and so you would do a spread in this way. So the asset legs that we're using is a long put at the higher strike, a short put at the lower strike. The profit characteristics: max profit is reached if China closes at or below the sold put at expiration. This is the ideal scenario. So if this is your 100 put and you sold it, this is your 95. Max profit occurs if you close here or below at expiration. Now, we're not holding this trade to expiration, so we're not going to get that max profit, but if price reaches this zone early, we can take what's there. Take what's there, which would be something just shy of max profit, depending on how far we are out from expiration. Now, the loss characteristics is only the net cost of the spread. That's the max risk that you're going to have. So whatever you pay to put that spread on, that's the max amount that you can lose. The decay characteristics: time decay is helpful when the position is winning and harmful when the position is losing. And again, both capped risk and reward. The strategy: use this strategy when you believe price will move lower but has limited downside potential. If the stock falls to the lower sold put, you make max profit. If this happens prior to expiration, go ahead and take profits. If the sold options loses its value, you can take profits on this leg and hold the long option as a free trade. Now, if the stock rises above the higher bought put, you take a max loss. You take a max loss. If the stock falls somewhere in between, then you must clear the break-even point, which is the higher strike minus the net debit. All right, let's take a look at a paper example here. So the execution of this strategy: we are going to buy the put debit spread when the underlying reaches your trigger. So again, if we have a bearish rejection day here, this is your absorption zone right here, absorption zone. If price pulls back to that area in the next day, that's your entry trigger. That is when you would put on your debit spread right at that point, and then the idea is that price will then drop toward the sold put, which would be your target. Now, XYZ is trading at 100. Okay, so it's trading at 100 in January, and you believe price will fall, but has limited downside to about 95. So you buy this put right here for $2. You sell this one for 50 cents. That gives you a net debit of $1.50, and that's the max amount that you can lose. So that's the net debit. Premium bought minus premium sold gives you your net debit. Your maximum risk is now that net debit, and the maximum reward is the difference in strikes minus the net debit paid. So $5 would be the spread from 100 to 95 minus the $1.50 you paid, and that gives you a maximum reward of $3.50. And remember, on a 5-point spread, if you can buy it for $1.67 or better, it's usually pretty good. It's a pretty good spread. Break even, the higher strike minus the net debit. Higher strike minus the net debit. 100 minus $1.50 is $98.50. Now your max profit occurs if price falls to the lower sold strike. We will take profits if this happens prior to expiration. If price closes above the higher bought strike at expiration, you take a max loss. If this happens prior to expiration, there is no harm in holding on to the position, as there is always a chance it could finish with value given there's still time remaining to expiration. However, if price basically breaks through our failure point in the trade sequence, I no longer want to be a part of that trade. So I'm not just going to hold on hoping, but you could. It's just not the way I would approach it, and not the way that I would ask you to approach it either. If price closes somewhere between the two strikes, then your break even is a higher strike minus the net debit. Again, 98.5. Let's take a look at an example. Again, this is Halliburton. We have our major $46 resistance level. And remember, the objective of this put debit spread is to execute a bearish trade by buying puts. Right? We're going to buy the 45 put, and then we're going to reduce risk by selling a lower put. In this case, we could sell the 40 put. So this is the 45. We can sell the 40, and now that's your 5-point spread. So you're buying this one, selling this one, and that reduces your cost. So right here, 38 days to expiration, the 45 put costs $1.54. The 40 put costs 35 cents. That gives you a net debit of $1.19. $1.19 is all you can lose in this instance, so it's your max risk. Your max reward, on the other hand, is $5 minus the $1.19, which gives you $3.81. That's your max reward, $3.81. Your break even in this case is going to be 45 minus the amount you paid, and that's $43.81. That's right here, $43.81. So basically, at expiration, because there's still 38 days to expiration, we would buy the 45 put, sell the 40 put, and now if price continues downward, again, we would make money along the way, and we have to clear this level by expiration to be break even. Again, I'm not looking to hold to expiration, because in most cases this type of trade would take somewhere between 2 to 3 weeks, which would be 10 to 15 trading days, and we still have 38 days left. So there's, plenty of time. I'm not going to be holding all the way to expiration in most cases. So again, plenty of days to expiration left, and we have a great trading range here to get behind, especially in this market. Now, remember, with any debit spread, I like 30 to 50 days. 30 to 50 days to expiration. If you start doing something less than that, the time decay is in days to expiration is very small. You have to be razor sharp in terms of your accuracy at that point. Price really needs to get to your target zone. Otherwise, give yourself a little more time. Give yourself a little more time to expiration. Give yourself time for the trade to work out. Many times, if I lose money on one of these, it's because I picked an expiration that was a little bit too close, and had I picked just the next expiration, even if it was just the next weekly expiration, it would have made money. So again, give yourself a little bit more time. The best time to buy in this scenario, again, anytime you're buying anything with regards to the options market, you want implied volatility to be generally low, because that will give you lower premiums, which means your debit will be lower. Time decay is offset with the sold put, and again, if price reaches your target zone, This is the target zone right here. From this high, we can project lower average monthly range. So over the course of the next month, price should drop somewhere between 41.87 and 40.52 based on average range over the last 10 months of trading. So it's a very high probability target zone. So that's why whenever I'm going to sell a put or sell something, I would put it generally in this zone. But with this case right here, the strike's 5 points out, so we put it right here. Now look to exit the position ahead of expiration, typically once your profit objective has been reached right in this zone. So again, we are going to be long the put at the higher strike, short the put at the lower strike with the same expiration. And then we're looking to engage that opportunity when our entry trigger is reached. Halliburton is right here. You can see the rejection at the midpoint the next day. Solid rejection. That's the point where you would execute this trade. Remember, we bought it for $1.19 here, and then over time, look how price drops right into our target zone. A big time drop. It took 1, 2, 3 days of going down quietly, and then bang, 1, 2, 3 days of heavy selling pressure, and price closes in the zone right away. Give it a little more time, and then price eventually closes at value. And again, this is a great time anywhere in here to take off that trade. And you can see that the cost of the spread on this day after it has hit value is $3.67. We put it on for $1.19. So you take $1.19 from $3.67, that gives you a net gain of $2.48. $2.48. That is double your initial investment there. So you make a gain of 208% on your initial debit. To double it would have been $2.38. We got $2.48 after we bought it back or sold it basically for $3.67. So basically this right here, a very solid approach to engaging a bearish move, but allows you to cap your risk, allows you to cap your downside, which is very, very significant. Okay, now again, whenever price hits this zone, take the money and run. But even so, say you bought 10 contracts of the spread up here. Whenever price goes this fast in my favor, I'm already lightening the load. I'm taking some off, and then I'm taking the rest off. Not usually will I hold the entire position the entire way. So as price moves in your favor nicely, look to pay yourself on a portion of that trade as it goes toward your target. And again, pay yourself as the market moves in your favor. So this was a great move. Again, you can see 208% gain. Now this was more than what we see with the put credit spreads or the call credit spreads, right? Gain 208% here, but you can only make a max 100% on the credit spreads because you can only make your credit. So the first option strategies in our strategy toolkit, credit spreads, you're going to make 100% of your trade at the max. With debit spreads, you can start making more multiples of that depending on how good the move is in your favor. All right, let's talk neutral strategies now. Neutral strategies include many, many different strategies. The ones that I typically engage would be the straddle, the long straddle, and the short iron butterfly. The long straddle here is a breakout strategy, and the iron butterfly is a range bound strategy. Now, I'll be honest, I don't use these as much, but there are certain scenarios where these are very, very beneficial, and understanding how to use those in those different circumstances is very, very important. You've got to be able to know when to use these strategies, so we'll discuss them right now. So first, what is a neutral option strategy? These are the strategies that allow traders to make money in markets that will either remain range bound or have the potential to see significant expansion. So these neutral strategies are for markets where you're seeing a lot of compression at the moment. And in the case of a long straddle, you are anticipating that at some point we are going to see significant expansion out of the current narrow range, either up or down. Whereas the iron butterfly is a range-based strategy. When this market is in a range, you are betting that price will stay in that range to expiration. So again, you have two different approaches with regards to neutral strategies. You have to be very careful on when you use these, and we'll talk about this here in a moment. So while there are many different strategies for trading a neutral market, we will primarily focus on executing long straddles for markets that are poised for expansion and selling iron butterflies for collecting premium during range-bound markets. Now here's the benefits of a neutral strategy. You can make money when you don't know direction. Isn't that great? You can make money even when you don't know the direction. Long straddles allow traders to make money even when you don't know which direction the market will break. However, you need to have enough of a breakout to cover the cost of executing this trade. And so you have to have a significant, a major breakout in order to engage a long straddle. If you don't think it's going to be a major aggressive breakout, then perhaps you have to find direction and be directional. But if you want to take it from a neutral standpoint, you got to have enough of a breakout in order to cover the cost of the trade. The second benefit, you can make money when the market is range bound. So the market doesn't have to go anywhere. It can just stay flat, literally flat, and you can make money with a short iron butterfly. A short iron butterfly allows traders to make money when a market has become range bound. In essence, you are able to take advantage of situations when the market isn't moving by selling premium. Commission costs can add up quickly with this four-leg trade, so you have to use accordingly. So again, these neutral strategies are very powerful when used in the right circumstances, but I would not overuse them. These are like the special china in the china cabinet that you bust out on the special occasions, right? A long straddle, there's only a couple of times a year where I may use something like that, but on those moments it is significant. Same thing with an iron butterfly. If you are very confident that a market will stay quiet, like during summertime trading in certain markets or holiday trading in certain markets, or maybe a market is anticipating earnings or news, so it's going to stay range bound, that's a time where you can use a short iron butterfly strategy. All right, let's talk about long straddles right now. Again, this is a breakout strategy. The objective of a long straddle is to execute a neutral trade for a capital gain while expecting a surge in volatility. Ideally, you are looking for a scenario where implied volatility is currently very low, giving you cheaper options prices, but the stock is about to make an explosive move, but you just don't know which direction. So in this case, direction is neutral, breakout, right? It's a neutral breakout. You don't know which way it's going to go. So sometimes you can have a market that's been going sideways for so long and all of a sudden it's coiling up. You know it's about to go. You just don't know whether it's going here or here. And so what we would do in this case is use two asset legs, a long call and a long put. And we would do it at the exact same strike and expiration. So say right here, this is your 100 level and it's been coiling around 100, 100, 100. Is it about to go to 110? Is it about to go to 90? Which way is it going to go? Sorry, that's 100. Is it about to go to 110 or is it about to go to 90? Which way? I don't know. But what you can do is buy the 100 call and you can buy the 100 put. You're buying one of each at the money. But because you're buying one of each at the money, it's going to be a little more expensive. So this cost for this type of trade is a little bit more expensive. So again, you have to have enough of a move to cover the cost. So when do you use it? When premiums are low and you think the market is ready for an explosive breakout in either direction. The profit characteristics, the profit is open-ended in both directions. Open-ended in both directions. So you have uncapped or unlimited max reward. The loss characteristics, Limited to the cost of the spread. The max loss occurs if the market closes at your strike at expiration. So if this thing is going like this, like this, like this, and it's 100, and you think that this is going to happen or this is going to happen, but instead it closes right there, then you have just lost max risk or max money on that one. And not only that, but time decay has hit you pretty hard because you are basically long premium in both directions, so you have double the decay characteristics that you would normally have. So decay characteristics here, time decay really works against this position, and I would say double time, because your long call is having time decay effects, and your long put is also having time decay effects. It's a double. So you need to get a move, you need to get it in a hurry, and you need to get enough move to cover the cost of that trade. So down here, use the strategy when premiums are low and you believe price will see a breakout in either direction. This is a high cost trade. Needs a big enough move to cover your costs because you're buying two at the money instruments. You're buying the at the money call, at the money put, and those are expensive being at the money. So you need a big enough move to cover those costs. And you have to consider this trade ahead of things like earnings. Consider a trade where you have major volatility, where you might see that major breakout. And so again, something like earnings might be a good time where prices are coiling up, and now you're either going to see big move after earnings up or a big move after earnings down. And again, this is a great strategy to use ahead of something like earnings. Now here you want to consider stocks with price ranges that are compressed and ready for expansion. So again, with this type of trade, you need compression. That's a foundational concept for us. Compression leads to expansion. Expansion leads to compression, right? And so if you see this concept here play out, for example, if it's been going sideways long enough, you could use a straddle here and you get a big breakout. And then after a big breakout trending move, you know that you might see a period of compression, and that's when perhaps you can use the short iron butterfly range strategy, right? And so again, compression leads to expansion, expansion leads to compression. Now with this one, I would normally say again, you always want to keep an eye on days to expiration. I would say with this one, you want 45 plus days to expiration. So you want to buy puts and calls with at least 45 days or more to expiration. Again, this could be kind of pricey because say you get up to 70 or 75 days, that might be more expensive because you have much more time value built into that trade. But again, you want to have something with enough time to expiration, enough days to expiration, because you want to give that trade enough time to cover costs, to get that breakout, and sometimes those breakout moves just take time and patience. Now this is very important. For a trade like this, for the long straddle, if the stock hasn't moved, sell your position. Sell it. If you are here and this thing has coiled up like this and you're like, wow, it's at 100, it's about to go, and then 5 days later it's still at 100, you got to sell that position, get rid of it, because by holding a position, you're going to start seeing serious time decay effects, especially if you get into the last month of that trade, right? If you're getting under 30 days to expiration, if you're getting under 20 days to expiration, and you really haven't seen a major breakout move, man, you're about to see a significant decay in the value of those options as time decay starts to take effect. So you have to keep that in mind. That is a very, very important point to remember. All right, let's take a look at an example here on paper. Number one, the execution. What we're looking to do here is you want to buy the long straddle when price of the underlying is at or very close to the strike you wish to straddle, and when volatility is low in order to pay cheaper premiums. So whenever price is chopping around like this, you want to basically put on the long straddle when price is right at that strike that you want to straddle. Now if you want to give it a little bit more of a bullish slant or a bearish slant, you can. For example, you could straddle something up here instead of down here. That'll be a little cheaper, perhaps, and then when price starts to go, again, it has more of a bullish slant to it. The same thing for down here, a little bit of a bearish slant if you did that. For the most part, though, I try to keep it right around the price that I want to straddle, right when price hits that point. Now, in terms of what's actually happening here, if XYZ is trading at 100 in January and you believe that price will experience a significant breakout soon, but direction is unknown, then you would buy the 100 call and also buy the 100 put. Now the 100 call, say it's 255, the 100 put is say 225. Now this is going to cost you $4.80 debit. Now compared to the other examples, the credit spread, what do we get, $1.20 or something in credit? The debit spread, we're paying what, $1.19 to sell a put debit spread. Look at the cost of this one. The cost is $4.80 because we're buying two at the money calls and puts, right? They're both at the money, which means they both have a lot of value right at that point. And so again, it's going to be a high cost trade. Now, in terms of the risk profile here, the net debit transaction is the premiums bought. You're adding up the premium that you bought for the call and for the put. Again, that's $4.80. Now, what's the maximum risk? It's $4.80. It's the amount you bought. That's the most you can lose. What's your maximum reward? Unlimited. It's unlimited because you can go up to the moon, and even if you had that put, right, the put's going to expire worthless, but this thing can continue to go to the moon. Now, on the downside, we don't go to the moon, but you can go to zero. So basically, it's unlimited to zero, basically, whatever that amount might be. Now, whenever you have this strategy, you have two break-even points because you straddled the 100 right here. You go 100 plus 480 gives you 104.80. And then you have 100 minus 480 gives you 95.20. Oops, 95.20. And so that is your break-even up and your break-even down because remember, you paid 480. You need to clear that cost by expiration. And so if price starts to break out and rally here, but there's still, say, 50 days to expiration, and you've rallied for 4 days up to 480, the value of this will no longer be 480. It might be much more. It might be 980, for example, right? So again, you want to rent this trade as well. But if price continues well beyond that level, you're going to make a profit beyond everything beyond 104.80. Same thing on the downside. If it were to break below 95.20, you're a profit on everything below 920 as this thing approaches expiration. So you have unlimited upside. You have a clear maximum risk, and then you have two break-even points, one up and one down, because you bought a put and a call. You add those two premiums, projected higher from the strike and projected lower from the strike to get your two break-even points. So this trade needs a big enough breakout to cover the costs of the net debit. You execute this strategy when volatility is low to pay cheaper premiums. And if price doesn't move, look to exit this trade 20 to 30 days before expiration, as time decay will begin to work doubly against this trade. Let's take a look at an example. Here is a neutral strategy example on VLO. This is perhaps one of the best trades from this year in terms of a straddle. I can think of probably 2 or 3 others that may compete, but this was a fantastic one. We had been following VLO in the trading room as this thing had trended higher. It had trended significantly higher, and here it took a great impulse sell-off and bounced back to the midpoint, giving us a great key range. After that, price went sideways for a very long time. Sideways, sideways, sideways. And after several weeks of sideways, we started to look at this as a potential straddle opportunity. And I remember in our monthly market outlook here looking at options for the 92 half straddle. And I mentioned at the time the 92 half straddle is the one to go with. And at the time, again, the call was 390 to buy an at the money call or around there, and it was 375 for the put. So a little bit more for the call than the put at the money. And when you combine those two, you get 765 of a net debit. So you're paying 390 for one, 375 for the other. That gives you 765. That means from the 92 half, project higher, 765, that gives you 100.15. You need to get beyond the 115 level in order to start making upside profit. That is your break even. You need to get beyond it. Down here, you need to get below 84.85 in order to start making money in this scenario. And again, everything beyond it is a home run to the downside. Now, with this one, some may argue, you know, this has been trending way up. This was a great consolidation. In most cases, this will break to the upside. And so, yes, you could just do a directional call strategy on this one. Maybe a call debit spread, maybe an in the money type of approach, but it's not guaranteed. It's not guaranteed that it'll break to the upside. Anything can happen. And so at this point, maybe you do want to do a straddle, but here's the key. The key is, look how long this market compressed. It compressed for a while, and it had gotten significantly more compressed as time went on, and that energy right there will tend to lead to this energy, whether it's up or whether it's down. Remember, compression leads to expansion, right? And so with regards to a straddle, you have to have enough energy built up in that range to where when a breakout does occur, it's going to see significant movement in that direction, one way or another. So the objective of a long straddle is to execute a neutral trade for a capital gain while expecting a surge in volatility, but you don't know which direction. Ideally, you are looking for a scenario where implied volatility is currently very low, giving you cheaper options prices, but is on the verge of expansion. Because prices went sideways for so many weeks, you know, this was a little lower than it could have been. The 92 half right here probably would have been a bit more volatile in terms of price, and the premiums would have been much higher at around this area than after 4, 5, 6 weeks of sideways. So again, you want to play a long straddle whenever implied volatility is low. Now again, 765 is your max risk. Break even up, break even down is your debit. Higher from the straddle and lower from the straddle. You got to clear those areas. Again, here are some tips. You want to buy when compression is significant. That's significant compression. And when implied volatility is low. It was. You want to buy with 45 plus days to expiration or more. Anything less than that, and you're probably going to see a pretty significant decline in values as the time decay really starts to work against both legs of this trade, both the long call and the long put. Now, if price doesn't move, remember, if we get into this trade here and price doesn't move, going sideways for 5 days, 8 days, 10 days, then you're going to want to get rid of that trade to avoid more time decay, especially as we get into the last month of the expiration of that contract. So very important. Lastly, breakout must be big enough to cover the premium paid for the trade. You have to see a big enough move, and that's why it's important to have enough range, enough compression to fuel the move that you need in order to get paid in this type of strategy. So here is how the trade turned out. If you recall, back in the April monthly market outlook here, I was looking for this to break out, and we looked at the 92 half straddle and mentioned this failed new low here looks really good. It's continued to hold here. I think it's actually time to go, and it may be to the upside. But just to be safe, the 92.5 straddle is the one to go with. And in this case, again, we got a significant breakout move into earnings. And then after earnings, it saw an even bigger move, and it eventually hit our target. So when this was coiling up and compressing around the 92.5, we used this key range right here to forecast this target right here, and the target was 117.01. So we know that 117 target was well beyond our 115 break even up if it were to break to the upside. And if this thing were to break to the downside, we had an equidistant target to the downside as well, projected downward from the 82.90. So there was an equidistant target up and an equidistant target down. In this case, an aggressive rally. Look at this thing just take off. It breaks through the break-even point early in the trade and just rips higher and eventually pushes higher through that target zone on this day here. And let's take a look at what the effects were. Right here, at the beginning of the trade, 390 plus 375, it cost us 765 for the May expiration, 40 days out, 46 days out. Remember, we like 45 plus days. We went 46 days out, it was 765. Now, at expiration, this is expiration right here, 46 days later at expiration, that call now was worth $28.05. $28.05 because we went 92.5 and it closed at 120.55. That is $28 and a nickel higher than this expiration. On the other hand, the put here expired worthless. It expired at $0. And so your value at expiration is $28.05. $28.05 on the 765 gives you a gain of 267% on that trade. Your net being $20.40. So you take $20.40 divided by 765, that gives you 267. A pretty solid move. Again, this is one of the better breakouts from the long straddle that I've seen over the course of the last year. There's others that look similar, but this was aggressive and beautiful as it continued right to our target. Tips: look to take partial profits after windfall moves. So again, I'm not one to hold 100% of the trade to expiration. Certain circumstances that may be good, but in most cases, as soon as you see a big pop in your favor, I'm taking partial profits along the way. And then you see another burst, I'm taking partial profits. And then you see the final burst, and you take final profits. That's a good way to go as price moves in your favor. It kind of helps soothe that monkey on your shoulder that says, should I take profits, should I not? And then you hold on, but price goes against you, and now you feel sad that you didn't take profits, right? So this is kind of a happy medium. Take a little bit, but leave a little bit. Take a little bit, but leave a little bit as this thing works out in your favor. So you want to be able to take profits on windfall moves. You also want to look to take profits once your profit objective has been met. I know that sounds easier said than done, but greed can easily rear its ugly head. There's many times where price will hit your target here, and then you say, I want more. And in most cases, you know what? That's often not the best idea. If it hits your target, take your profits, because chances are it hit other people's targets too, and they will be taking profits, which will adversely affect that position. So again, look to take profits at your profit objective. Now, should price close way in the money, allow the options to expire to avoid paying commission on the exit. So again, with this one continuing way up and it's getting closer and closer to expiration, again, you're way in the money. You can have the option at that point to allow the trade to hold the trade all the way to expiration, and at that point you won't have to pay commission on the back end. Now, I wanted to show something a little bit to give you an idea about how many days out and what the potential return is on your money. And so, for example, the 92 half straddle was for 46 days out and 74 days out. But if we were looking at something 18 days out, it was only 91 half. You had to go the 91 half straddle. And so if you did the 91 half straddle 18 days out, it would have cost $4.80. $4.80. That's your debit right here on April 2nd. Okay? Right here, at the same time, the same day, 46 days out, because there's more time value, right? $7.65 is the amount you would pay for 46 days out at the 92 half. And then if you decided to give even more time to the trade, 74 days out, then you would have paid $9.28. So you can basically see what the actual time value is of this trade. For 46 days out versus 74 days out at the exact same strike, there's a difference here from 928 to 765. That difference is time value for that chart. And so again, you're paying for a little bit more time to allow it to do its thing. Now at first expiration, that's right here, April 20th. At the first expiration, the 91 half was now worth $16.92. $16.92, and that was all the call. Remember, the call is the one that's in the money. The put is $0 because it's expired worthless. So $16.92 is basically the entire worth of the 91 half call. And so you made $16.92 minus $4.80, which gives you a net gain of $12.12. That is 250% of your original debit. Okay, that's at first expiration. At first expiration, also, if you had, conversely, the 92 half and you paid $7.65 at the same time, this one would be worth $16.40, which is a net gain of $8.75, because remember, you paid more because you had more time value. And so even though these are about the same, you paid less here, so you make much more gain, $2.54. But even on the 92 half, it's 114% gain already, because it's now worth $8.75 and you paid $7.65, right? And so you still made quite a bit more and doubled at that point. Now we look at something 74 days out, $16.90 in this case. Only 82% gain in this case, because again, you paid a little bit more because of time value, and so you make a little bit less. Now this is the case with many things. That's what I mentioned earlier. When there is less time to expiration and you get a big move, you're going to get paid much more. If there's lots of time to expiration and you get a big move, you're going to get paid a little bit less, right? Because again, time value. And again, days to expiration, that whole thing. So in this case, you're not always sure how fast the market's going to break out. So I would not be looking to do a straddle with 18 days out. I was just showing this for educational purposes on what it looks like in terms of the value of each of these after an X amount of move. Now at the next expiration, which is May 18th, this is the expiration that we engaged. That's 46 right there, 92 half straddle. Now at the second expiration, it's now worth $28.22. Your net gain in that case is $20.57, because you're taking $28.22 minus the $7.65 that you paid. You're going to get a net of $20.57. That's a gain of 269% on the original. So that's more like it. That's about what you would do 46 days out. Now look at the 74 days out. Again, you paid $9.28, and at this expiration, it's $28.28 is the value at that point. And again, subtracting the $9.28, you get $19 as your net gain. It's 205% gain. So again, less days to expiration, more percentage gain. in most cases because you're paying much more in time value for that opportunity. So again, 46 plus days, 46 to 75 would be a really good amount of days. I wouldn't really go beyond 75 because you start to have much more time value and it becomes a little bit more expensive in that case. But there are scenarios and situations for everything. So if you have to go 90 days out, then go 90 days out. But you have to be sure about the opportunity. You have to know that you need enough juice in here, enough fuel to trigger a significant move, right? And secondly, if you go that far out, you got to start getting paid soonishly. Within 5 or 10 days, you want to see price pushing in your favor. Otherwise, time value is really going to start hurting that trade. So tips: it is vital to buy a straddle when volatility is low, so premiums will be cheaper. Give the straddle enough time to be right. Sometime between 45 and 90 days. That seems about right. I wouldn't normally go beyond that unless it's a special circumstance. And in that case, I might just go ahead and be directional anyway. So again, with this type of strategy, somewhere in that zone seems about right. If expecting an imminent breakout, buying the straddle with the closest expiration will be cheaper and will return a larger percentage gain. So for example, this one might be okay to buy that straddle if tomorrow or if the next day had earnings. Because if earnings comes into play, then maybe you gap way up here right away and now that straddle is worth a good amount and you can take that off. So I'm not saying never. So never say never in terms of buying a straddle with less than 46 days or less than 20 days to expiration. There's always a scenario, but you just have to understand that scenario, understand the risks associated with it, and again, make the right decision for the play at that time. Over here, ideally, the position will hit its profit objective before the last 2 weeks to expiration, as time decay will hit this position twice as hard. So again, if you hit your profit objective, take your money, take your profits, move on to the next one, or at the very least, take partial profits. Take partial profits and then hold some if you really want to. Lastly, dump this position early if price doesn't begin to see expansion quickly, because time decay will begin to hit it hard. Okay, in this section we are going to discuss the short iron butterfly. The objective of a short iron butterfly is to execute a neutral trade for a capital gain while expecting price to remain mostly range bound. Ideally, you are looking for a scenario where implied volatility is currently very high, giving you high options premiums to sell, but price action is likely to become range bound as volatility decreases. This strategy combines put and call credit spreads. And so that's very important to note. Again, sometimes some of these option strategies can be very, very confusing for especially some early beginners, but for the most part, once you get the handle of it, everything kind of connects very nicely. And the credit spreads here, remember, a put credit spread, right? The put credit spread, you're selling this put right here, the higher put, and you're buying the lower for protection. The call credit spread, you're selling this call right here, right? And then you're buying one higher for protection. All a short iron butterfly is doing this at the same time and these strikes being the same price. That's what an iron butterfly is. It's combining those areas. So if you think price is going to go flat, sideways within a range, by selling the at-the-money call and selling the at-the-money put, you are going to get higher premiums because there's more value in those options at those levels. So you can sell for higher premium, and then you buy the outside wings up here for protection and down here for protection. So basically, you are selling your call and your put right here, and then you buy the call up here for protection in case this thing goes like this. You buy the put way down here in case price does that. But for the most part, you want price to do this and close right around where you sold it. So again, this is a range-bound strategy. And so the direction for this one is neutral. It's a range. You believe that prices will stay within some range. Again, you want to do this when implied volatility is high, but that's not always the case. Implied volatility might mean, hey, this thing just rallied significantly like that and now it's sold off pretty hard. The volatility is pretty high, but now you might actually see some compression as this thing digests the recent price move, and that would be a great time to use a strategy like a short iron butterfly. So, in terms of the asset legs, this one has 4 different legs. You are short the at the money call, you are short the at the money put, and then you buy a long out of the money call and you buy a long out of the money put. So there's 4 different legs, which means there's more commissions involved, there's higher costs involved. That's why I mentioned with these neutral strategies, there's going to be much more cost involved with the long straddle and the short iron butterfly, so you want to use them in the right situations. In terms of when to use it, when premiums are high and you expect the market to become range bound. However, you never want to use this strategy in front of news or earnings or anything where significant volatility can cause the price of that underlying to spike or drop significantly, because that's when this thing will lose. Ideally, you want prices to remain quiet and you want volatility to drop in most cases. So loss characteristics, limited to the difference in strikes minus the net credit received. Decay, time decay significantly helps this trade. Remember, you're selling premium, just like you're selling premium here. And so when you're selling premium, time decay is on your side. The max risk for this is capped to the net credit you receive. The max risk is capped to the difference in strikes minus the net credit received, and the reward is also capped to the credit received. So this is a cap strategy on both sides. Again, a good strategy to use during range-bound markets. Right here, use this strategy when premiums are high and you believe price will become range-bound and volatility will drop. For a neutral bias, you can sell at the money puts and calls, but you can add a directional bias to the position by selling puts and calls above or below current price. So for example, if you believe that price is going to rally and then fall short, you could sell the at the money puts and calls somewhere a bit higher than current price because you believe that it's going to go here and get stuck. For example, a good time when that would be the case is, for example, if you have a D-shaped profile, here's value, VPOC, and price is somewhere down here and it's rallying from this low, you may believe that price will return to value, and upon returning to value, price may become stuck and chop around value. So again, that would be a time when you could perhaps use a directional short iron butterfly in that instance. Okay, over here, do not trade this strategy ahead of earnings or news. Again, you do not want increased volatility. You do not want price breaking out of the range. You need for price to stay close to or around the short put and call that you sold. Over here, consider stocks that have experienced major volatility and are due for compression. Use this strategy with 30 days or less to expiration, but preferably less than 15 days. Again, I'm a big fan of 15 days or less, basically. Anything 10 days to 15 is really good. And even, again, a little bit more can be okay because sometimes markets get into a long-term accumulation phase. And again, that could be an instance where you could go 30 days out, but I really wouldn't go well beyond that because, again, what we're trying to do, again, is be on the side of time decay, and time decay really starts to fall off 20 days and 10 days to expiration. That really starts to be the case. And so if you go 30 days out, there may be more value to sell in terms of the premium, and then price will decay, or rather the time value will whittle away and decay that position as it heads towards expiration. Here, you look to close out the position just before expiration, as most of the profit will be realized closer to expiration. So again, because the time decay accelerates into the last several days, 10 days, 5 days, and in the last 1 to 2 days, everything is right in this zone for the most part. So if you hold it up until expiration and close it out just before expiration, maybe the day of, that's where you're going to get your most bang for the buck in this instance. All right, here is an example. So number one, the execution of this strategy. Sell the iron butterfly when price of the underlying is at or very close to the strike you wish to straddle, and when implied volatility is high, in order to collect higher premium. So again, if prices formed an impulse move of some sort and you believe that it's going to just chop around the midpoint, you want to sell when price is around the strike you want to straddle. So say price is trading around the 100 strike, you sell the put and the call at the money. So you sell the 100 put and call, and because they are at the money, they're going to be more expensive here, so there's more premium to collect. $2.40 for the put, $2 for the call. And then for protection, because you never want to sell naked, for protection, maybe you buy out here and you buy down here and out of the money, right? Out of the money, out of the money. And this would be your call up here just in case price were to rally. That would protect you. And this would be your put down here just in case price were to drop. This one would protect you. So you would take that spread of the strikes from the put to the call, and then you would subtract the premium that you collected in order to find your break even as well. So again, let's take a look at what that looks like. Right here, that's your 100 strike. You think it's going to continue to chop, so you sell these two. You buy way out of the money up here, 40 cents. You buy out of the money down here, 60 cents. And now you take that dollar away from the 440 and you end up with 340. That's your net credit for this transaction. So premium sold minus premium bought. The total of the premium sold, 440, minus $1 for the premium bought. That's 340 in terms of the net credit transaction. Now the maximum risk, again, the sold strike minus the bought strike minus the net credit. And so you have the sold strike, which is, say, the 100 strike right here. Which one did you buy? You know, you can use any of them. Ideally, they're equidistant. So say this is the 95 here, that's $5. And then you have a net credit minus 340. And that gives you $1.60 right here. And that's your maximum risk. In terms of the max reward, again, it's the net credit you received at 340. And now the break even up and the break even down would be 100 plus 340. And down here it would be 100 minus 340. And that gives you 103.40 on the upside and 96.60 on the downside in terms of your break even up and break even down levels. This trade needs implied volatility to drop for price to remain near, and for price to remain near that sold strike. So here, if this thing is trading like this and you sold the 100, you're going to notice that at the money here, you're going to collect the most premium. But if price moves away from that level, you're going to see that premium drop significantly and get very cheap. And then when it comes up here, it's going to again be very cheap. And so every time you don't want it to really move too much back and forth, because that could be a headache. You don't want a trading range, because if you sell here and it goes up, then goes down, then goes up, then goes down, you're going to be above and below the water every single time. So again, you want volatility to drop, you want prices to remain quiet, and you want for, by the time expiration comes, you want price to have closed or be very close to the sold strikes. So right here, this is a high cost trade. So again, high cost trade, use accordingly. It's not for everybody, it's not for every situation. Only the right situations where you really believe that you're likely going to see price stay at a price. And sometimes you can look at the open interest to see where that might be. For example, in this case, and many times, if the open interest is very high, say there's 25,000 contracts of open interest at the 100 strike, and yet the 95 strike, or well, I guess 95 down here, and the 105 strike up here may only have something like, say, 5K. And this one might have 5K. there's much more of a gravitational force to the 25K. That's a good time where you might say, hey, I'm going to sell that area because it's likely going to stick around that price. So there's many things you can do, but again, you want to make sure that price is going to stay in a range. You want to make sure that volatility is dropping, and you want to be able to close this one out ahead of expiration, just before expiration, so you avoid any kind of assignment issues, and so that you also take the majority of the trade. So again, this is a good opportunity, but you have to use it accordingly. Let's take a look at Momo. So again, this is a short iron butterfly, which is used for trading ranges. The objective of a short iron butterfly is to execute a neutral trade for a capital gain, while expecting price to remain mostly range bound. Ideally, you are looking for a scenario where implied volatility is currently very high, giving you high options premiums to sell, but price action is likely to become range bound as volatility decreases. This strategy combines put and call credit spreads. So again, if we believe that price is just going to stay right around the 37 put, because we had this great uptrending behavior here out of this one, rallying from $26 to $40 and change, and then we had an impulse sell-off down to the low and then back to the midpoint. That gives us a great key range. And now what we can do is say, okay, well, I believe price is likely going to stay around 37 bucks. It might go a little above, might go a little below, but overall I think it's going to stay around 37. So in this case, you want to sell the 37 call, sell the 37 put. Right at that strike, you're going to collect a credit on those sold options. The net credit will be after you buy your wings up here. You're buying the 40 and you're buying the 34. So again, 37 bucks is the strike to sell, and then you're buying 40 in case it breaks up. You're buying 34 in case it breaks down. Those are your protection wings there. And once you do all of that, you sell these two, you buy that, you end up with a net credit of $2.25. $2.25. Again, premiums are a little higher, quite a bit of volatility, increased volatility here, and now $2.25 with only a max risk of 75 cents. So what you're doing is you're taking 37, you're subtracting 34, that's $3, and then you subtract your net credit of $2.25, and that gives you 75 cents of risk. Your max reward will be the credit that you collected. So again, that's how it looks. Over here, sell the iron fly when implied volatility is high to collect higher premiums. Sell the iron fly when price is likely to become range bound. Sell the iron fly when implied volatility is likely to decline. And do not use this strategy ahead of earnings or anticipated news. And buy farther out of the money calls and puts for a wider break-even range. So if you want a wider range, right now that's a break-even up, that's a break-even down. But if you buy, say, the 42 out of the money and the 32 out of the money, it's going to open up your break-even. But it's also, perhaps, again, you want prices to stay inside the range. So again, you don't want a whole lot of back and forth, but that'll open up your break-evens just a little bit as well. Okay, so right here, what you'll notice, the iron butterfly credits on March 29th for this one, there's 3 different ones to choose from. There's the weekly April 6 options, 8 days out, the weekly April 13th options, 15 days out, and then the monthly April 20th, 22 days out. So there's 3 different ones to choose from here in this case. And again, I wanted to show you this for reference so that you can see, the amount of time left to expiration. Days to expiration, 8 days, so you're going to get $1.85. Days to expiration, 22 days, so you're going to get $2.25. Somewhere in the middle, $2.10. Again, it's up to you to decide which one to use, and ideally you want to use the one where you believe price is going to close around that level. So if you think it's going to close around that level in 22 days, then go ahead and grab that one. If you think it may close there in 8 days, you can grab that one. You can grab a combination if you wanted. But for the most part, I wanted to show that for purposes of understanding how many days to expiration and what that might look like in terms of the credit you may receive. Now moving forward to the next chart here, Momo is now complete. Okay, this is the April 20th expiration. That's that date. The April 6th expiration was here, and the April 13th expiration is that close right there. When we put the trade on, it was about right here, right? 37 bucks. And you can see for the most part, 1 day, 2 days, 3 days, 4 days, 5 days, 6 days, 7 days, it went sideways. A great move, going sideways for the most part. And again, that's optimum. That's what you want to see. And that can typically happen. And again, there's time decay right there will whittle that position. So if you would have got 225 by selling here, by the time you get to here, that 225 with time value now decayed might be worth only 180, right? And so you've pocketed that rest. But then when price drops down to here, that's significant, right? Now you're hurting here because now price has dropped down where it's below the break even. And again, you want decreased volatility. You want price to stay in a quiet range. And so that's what I mentioned before. Sometimes when it's quiet like this, that's good. But if you start getting away from that range, you got to know that, again, you're going to take a little bit of hit on the premium there. But, again, because this is a key range, we're expecting prices to remain within the range, and then price bounces back and closes near the low anyways. And so, again, to close right here, let's do some math here for a moment. The value of the April 20th iron butterfly at expiration is now 67 cents. So at the beginning over here, it was $2.25. But by the time we got all the way to expiration, it was worth 67 cents. That's a good amount here that you were able to pocket. That's a total of $1.58. That's your final credit. And if you look at the actual options, the 40 call that you bought way up here was worth 0. The 37 call that you bought right here, it's below there. It's worth 0. The 34 put that you bought down here, it's above it. It's worth 0. And so you're left with the only one that's in the money. That's the 37 put. It's not in the money by much. It's only in the money by 67 cents. So you take 37 from 36, 33 there. That's 67 cents. Basically, that is your final credit right there. And so let's look at this in terms of the credits. Notice how the value of the iron butterfly fluctuates as price gets closer and farther away from the sold strikes, and how this impacts options with closer expirations versus expirations farther away. So there's more time value. The stuff that's expiring closer will have more of a reaction to prices. So here's the day you put it on, 185, 210, 225. Right? That's March 29. On April 2nd, that price is now 175, 207, and 230. And then on April 6th, at the expiration right here, it's this one right here, which was $1.85 earlier, is now worth 52 cents only. That 52 cents, again, is all that it's worth. And again, that's a good gain right there. Over here, you can see that while this one reached expiration or very close to it here, 52 cents, these two are still holding their values because there's still more time left. And then the next day, or the next expiration on the 13th, you can see it dropped so far away from the 37s, it actually closed right at or below, just below the break-even point of 34.75. So for this one, it actually lost money. Because while it was here, which was great, 2 days later, 2 days, price drops right here just below your break even. And so you can see the weekly that expires here at 15, that one at expiration was 227 versus the 210. That was a loss there of about 17 ticks. So again, not a big deal in terms of a loss because you had great risk-defined strategy, but at the same time, you can see that it doesn't take much sometimes for this thing to go away from your strike and start to impact that trade. By the same token over here, when price dropped away from this move, there was still a week left to trade with the April option. So while this one was above its above its entry point here, this one was still just barely in the money by 10 ticks, 10 cents. And then when price rallied back to the close to end very close to the 37s, again it closes at 67 cents. So again, this gives you a really good understanding of how the value of this short iron butterfly fluctuates as price moves closer to the sold area, the sold strike, and then farther away from it. And then also how that affects options with closer expirations versus farther out expirations. So this is a very important chart to study here with regards to this strategy. Again, you want to use the short iron butterfly strategy after price experiences volatility and is likely due for compression. This trade needs implied volatility to drop and for price to remain near the sold strike. So here's a couple of tips. Look to close out the position just before expiration, as most of the profit will be realized closer to expiration. Additionally, for a neutral bias, you can sell the at-the-money put calls, but you can also put a directional bias as well and sell put calls above or below the current price if you believe that price is going to move to that strike and then sit. Now, keep in mind, the reason this is called an iron butterfly, anything in options with the word iron in it means that you are combining puts and calls. That's all it means. You're combining puts and calls. And so the reason I use this approach versus, say, a normal butterfly, something like that, is because generally speaking, by selling premium at both the put and the call, you're going to get more of a credit in many cases. But again, every scenario is a little different. One other thing to consider, while this is a butterfly strategy, and a short iron butterfly strategy where you're straddling one strike, you can use the iron condor approach by just opening this up a little bit. So instead of selling the 37, you could sell basically the 38 call and the 36 call and widen that out, still by the wings, and now that's an iron condor type of strategy. So again, this is the short iron butterfly. This is the one I like to use in this scenario, but you just have to understand the movement that it can have so that you can engage it the right way. But this is a very strong candidate for a range bound strategy. Alright, let's talk in the money options now. Remember, we're going down the list right here of all of our various option strategies that we want to use in our toolkit. Number 1, credit spreads. Number 2, debit spreads. We had neutral strategies. And now we're coming into in the money options. So you can see, again, this is least risky. This is most risky the way I'm defining it. And we're now kind of getting toward the more risky portion of these strategies. And again, the reason why it's more risky is because you have more built-in value. You're paying a little bit more for the strategy. So in the money options are options that are in the money, which means the stock price is above the strike price for the calls and below the strike price for puts, thus giving these options intrinsic and time value. These options are more expensive, and the farther in the money they are, the more expensive the options become. In the money options means the stock price is above the stock price, the strike price for calls, and below the strike price for puts, which gives these options intrinsic value and time value, thus making them more valuable and expensive. So the two types, again, in the money long calls, in the money long puts. How do I define in the money in terms of which ones I want to buy? Well, the ones I want to buy generally have a 70 delta around there. So if you look at the delta, a 70 delta would give you a roughly 70% odds that in the money call or put will be in the money at expiration. And as such, you're going to receive about 70% of the gains dollar for dollar as this thing continues higher. The thing is, when we enter a 70 delta, as price moves in your favor, so too does this delta move higher. It'll become 80%, then 90%, and then it'll be right at 100%, 1-to-1, right on expiration day, right? So this is all very important to understand, but you don't really have to fully understand it to make money. I mean, just understanding that these deltas in the money, if you grab a 70 here, you have good odds of that strike being in the money at expiration, and thus you will be paid more. So if you want to be more aggressive, for example, remember step 2 in Swing Trade Pro is all about trade sequences. And so with that in mind, if we want to be super aggressive with our strategy because we believe price is about to rally significantly, we have a huge rejection day, and we believe we are about to make a massive move up, then you're going to want to buy something like a 70 delta in the money call in order to take advantage of that move and be more aggressive about it. Right here, benefits of in the money options. So number one, they have more value. In the money options have more value, so you get what you pay for with these options. These options will retain more value if the position begins to go against you due to intrinsic value. Very, very important concept. Say this is a 100 strike right here, and that's the in the money 70 delta. Well, that probably means that price is somewhere up here, 105, maybe 110. That's current price. So if the value of this strike right here is, say, I don't know, maybe $8. If price were to drop down a little bit, this one would be less affected than something that was out of the money. So say you bought the 107 out of the money option. If price is at 105 and starts to drop, the value of this one will sink very quickly. Whereas this one's in the money, it's going to maintain or retain a lot of its value. Maybe if it pulls back a little bit, it might be worth $6 instead. Whereas this one will go from, like, say 40 cents down to about a nickel. It's going to lose a lot of value very quickly, whatever the case might be. So again, that's what makes these options so powerful. Even if this trade goes against you, it's going to retain more of its value than an out of the money counterpart. Over here, less risky, just slightly though. In the money options are less risky compared to out of the money options due to having both intrinsic and time value. So while this can be risky because it is more expensive and valuable, it's going to be less risky than out of the money options purely because of the probability of profit. This means that they will be more forgiving should the position go on against you and against your desired direction. So again, these options very strong for an aggressive type of move. It's a really, really good candidate to watch for if you really believe that you're about to see an aggressive move, a big time move in the market. Oftentimes in the money options are the best way to go to take advantage of that move. It's going to cost more, but at the same time it's going to be a better way to go to capture that move, especially in those cases where you want to be more aggressive. Alright, let's take a look at the in the money long call example. For execution, you buy the in the money long call options a 70 delta or better when price of the underlying reaches your entry trigger. Again, same concept, major rejection day trade sequence, major pivot point here at the mid. You want price to open above that level and then drop into it, and right at this point is when you want to put that trade on. You want to buy it right here at your entry trigger. And again, that's the optimum point to take advantage of that entry at the best point. Over here, let's take a look at what it actually looks like. XYZ is trading at 100, and you believe that price will experience a high probability move to the upside. So say, for example, there's support, 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 support. You see a major rejection here at support, and that's right at 100 bucks. And you believe that this type of move is likely coming. Well, in this case, if you want to buy the in the money 70 delta, perhaps you buy the 97.50, which is somewhere below that 100 strike where we're currently at. You buy the 97.50 for $3.55. And so now, again, that's your premium bought, but that's also the max amount that you can lose. Your maximum risk is $3.55. Now, in terms of the upside reward, your reward is unlimited to the upside. So again, this thing can theoretically go all the way to 1,000,000, and you would get paid up to expiration up to 1,000,000. But I've never seen that happen in price. But I mean, theoretically speaking, it is unlimited. Now, in terms of where your break even is, remember, it's the strike price plus the net debit. So if you are currently trading 100 here, and you bought the 97 half strike down here, 97 half plus 355 would give you 101.05. That is your break even, and so you need price at least by the expiration to be at or beyond this level in order to cover your cost. So again, that is your break even. It's the strike that you bought, the in the money 70 delta, along with the amount of premium you paid for it. That's 355. You just need price to close beyond the strike plus 355, 101.05 in order to break even or better that trade. But again, that's at expiration. At expiration, what if, you know, there's 35 days left to expiration and you're at 101.05? That's not break even for you. It's actually, you're going to be much higher than that. It's probably going to be, say, $6 at that point, as this thing is powered higher. You know, again, you're going to want to be above this point at expiration, but I don't normally hold these to expiration. I'm looking to take this trade off the table on that pop into my target zone. So this trade needs a big enough move to cover the net debit cost if you hold it to expiration. Execute this strategy when you expect a high probability move higher. So when you feel like it's about to see a high probability move higher, or if you're about to see an aggressive push to the upside, this is when you want to use this strategy. Now, it is not necessary to hold this trade to expiration, especially if your profit targets have been reached. So oftentimes I'll have a series of profit targets. I'll have a significant high probability target zone up here. But if price pops in my favor really quickly, I'll look to take some off the table here. And as price continues to go on, I'll take a little bit more and more until we get to that profit target. Lastly, give yourself enough time in the trade, days to expiration, to be right. Ideally, 45 plus days to expiration, again, is a good amount. Because this isn't in the money, you're going to pay a little bit more premium. So if you're looking at 90 days out, that might be way too far. Again, 30 to 45 days is a good amount for this one. But give yourself enough time to be right. Again, we're using Wynn Resorts as our example. A great rejection at the 160 level. And so at 160 here, again, kind of like that 100 example I was just using, major support at 160, a major breakdown, but then it closes back above. This triggers our rejection day trade sequence. And so if I was looking to engage in the money long calls, then I would buy the 155 call. It's going to be below the current price or below the rejection area. So right here, this price is 163 is the close. We'd be buying the 185 in the money call. And again, look, it's $8 in the money. For the 155 call, when it pulled back to the entry point, it was going to be, it is or was $7.20 for that call. And so that's the net debit that you would pay, $7.20. The max risk you can have is also $7.20. And the upside profit potential is unlimited. And in this case, if we were going to hold this trade to expiration, then we would need price to close at least above the 162.20 level, which is 720 plus the 155 strike. So again, very important to understand those concepts. Now, the objective of using the in the money long call is to execute a bullish trade when you are highly bullish and want to be aggressive. This approach improves overall return versus buying the underlying outright while inherently protecting your downside. Again, this one had huge implications. It had major allegations and huge drop that occurred. It was not clear if we were going to bounce at all or if we were going to continue lower. So again, in the money long call here might be an aggressive approach for something coming off of significant news events, but at the same time, your midpoint is your failure point. If price were to close below that level, you could take off the 155 call. You're going to lose a little bit, but maybe you might be, say, at 450 or something. So if price were to close below the 160 level, it's still $5 in the money. And so you might be around 450 instead of 720. So instead of losing the entire amount, you only lose a little bit here. So again, you want to be able to use that midpoint right there as an exit point if price closes below it. So in this case here, you want to buy when the implied volatility is low, because you are buying, again, you're buying premium here. You're buying an in-the-money long call. So if implied volatility is generally low, you're going to pay a little bit less. If implied volatility is high, this number right here will be much higher. So again, you want to moderate depending on the volatility situation. Now, you want to buy with 30 to 50 days to expiration. Your time decay, again, is going to work against you in this situation. So if price pushes higher in your favor right away, look to take those profits. You're always looking to take windfall profits as price pushes in your favor. That's what you have to do as a trader. You have to pay yourself, and as this thing continues higher, pay yourself in your target zone. Lastly, look to take profits once your profit objective has been met. In this case, I had a profit objective at 170 and as high as 180. But again, things happen, and so sometimes you get a move well beyond that zone. And when you're long in the money calls, you're not necessarily capping your upside, right? You have unlimited upside, and so it makes for a great opportunity to really take advantage of those major moves that could happen. So let's take a look at the result here. Remember when our trusty example here closed at expiration at 185 after a major push up. Remember, I actually took a 160, 170 call debit spread, and I capped my upside and took the profits here. Had I been in the money, I would have been able to take more advantage of the major pop that happened. And so in this case, 720 is what you paid for the in the money 155 call. But remember, on a big pop up as high as 94s, 93s, this thing closes 185. 185 from the 155s, that's almost a full 30 handles in the money. It closes 29.73 in the money at expiration. You subtract your 720 and you get 22.53 of net gain. That works out to 313% gain on this move. And again, not capping your upside was very, very useful in this scenario when a major squeeze occurred multiple days in a row. Again, any of the other examples could have capped your upside. This one here, a big time push through it. So look to take profits after windfall moves. Again, on this big pop here was a great time to take profits. The next pot is another great time to take partial profits. And then again, normally I want to take profits ahead of expiration, not usually holding to expiration, but I wanted to show these examples at expiration so you can see what it looks like. Over here, tips. Look to take profits after windfall. Look to take profits once your profit objective has been met. And then should price close way in the money, allow the options to expire to avoid paying commission on the exit. So again, your 155 is here. Major pop up. But this was a major pop-up with not a whole lot of days left to expiration. After it popped, there was only 5 days left to expiration. So you could have just let it sit there, fall flat, and then hold it to expiration, not pay any exit costs. But at the same time, you'd let it pull back a little bit to that point where you could have taken it a little bit higher. So again, it's always kind of an art form on how you take profits. But I would say every time you get that windfall pop in your favor, pay yourself, take some profits, at least on a partial position. Alright, let's discuss in-the-money options now. The objective of using in-the-money long puts is to execute a bearish trade when you are highly bearish and want to be aggressive. So this is the bearish counterpart to the in-the-money long calls. So we're down here at the moment, right? In-the-money long calls, in-the-money long puts. This is when you want to be bearish. Same concept as the in-the-money long calls. You want to buy the 70 delta put, and you want to use this strategy when you're very, very aggressive. And so, again, you want to buy the in-the-money long puts to execute a bearish trade when you are highly bearish and want to be aggressive. This approach improves overall return versus selling the underlying outright, while inherently protecting your upside risk. So again, you're only going to lose the amount you paid for that option. You're not going to lose more, and inherently, again, that's a much better risk profile than other approaches. Over here, it's a bearish direction. The asset legs is only a long put at a 70 delta or thereabouts. When do you use it? When you are highly bearish. Highly bearish. You really think the market's about to do this, so you want to buy the put that's above the recent high at a 70 delta, right? Profit characteristics. Profit increases as the market falls with unlimited profit potential, and there should be a little asterisk right here, to zero, because you can't really go through zero. So once price of the underlying hits zero, your unlimited profit potential is basically limited at that point. But for the most part, this thing has unlimited profit potential because not many will go to zero. So again, if you're good enough to sell something up way up here at 100 and take it exactly to zero, that's a pretty solid trade. But in most cases, that won't be the case, and so we say it's still unlimited to a price of zero. Over here, loss characteristics only limited to the amount you paid for the puts, and the decay characteristics very similar to the in-the-money long calls. The time decay is going to erode the value of the options as expiration approaches. So the closer you get to expiration, that time decay really starts to whittle away at the price of the options. So max reward unlimited, max risk capped, and in terms of the strategy, use this strategy when you are extremely bearish and believe price will move lower. The cost of the option will be higher, which carries more risk, but being in the money gives the option more intrinsic value, so it's going to take less of a hit on adverse moves, and again, it's going to pay more if you are right. Give yourself enough time to be right before expiration. Somewhere between 30 and 45 days is usually a good approach. The trade is profitable at expiration if price closes below the break-even point, which is the strike minus the price paid for the put. If the stock price rises above the strike of the put, you take a max loss. In this scenario, just allow the puts to expire worthless, pay no commission, and you don't have to deliver stock. Because again, you're not selling these, you bought them. And since you bought them and they're worthless now, might as well just let them continue to be worthless because you bought them. You pay no commission on the exit, and you don't have to deliver anything. So again, that's a great way to go to, again, squeeze out a little bit more efficiency out of your portfolio, right? By not paying commission. Squeeze out a little bit more in that case. But that's only in the case where price rises above the strike of the put and you take a max loss. Now that's if you want to take that max loss to expiration. In most cases, I will be looking to exit that out of the money. That in the money long put. I will be looking to exit it as soon as my trade sequence has failed. So again, I will not usually be holding to expiration, but there are scenarios where that would happen. Say there's only a few days left to expiration in general. On a weekly option, for example, that would be one of those cases where you can just let it expire worthless, pay no commissions on the back end, and you're done. Okay, let's take a look at an example of the in-the-money long put. Number one, you want to buy the in-the-money long put option 70 delta or better when the price of the underlying reaches your entry trigger. So again, whenever you get a midpoint retest or you get a retest of an absorption zone, that's the zone where you want to put this trade on. Again, XYZ is trading at 100 in January, and you believe that price will experience a high probability move to the downside. So say it's right here, that's your 100 strike. That area has been resistance, resistance, resistance. Maybe we had a significant rejection tail above it, and now you think that this is going to happen. Well, buying an in the money put would be, say, the 102.50 up here, and you believe that this is the high, so it's not likely to come up here. Whenever price pulls back to the midpoint, that could be a great way to enter that trade. And now if you pay $355 for that 102 put, again, it's the strike minus the amount you paid. That's your break even. So price would need to go at least to 98.95 or below by expiration for you to be break even or better. And again, that's just if you leave it to expiration. Again, we're looking to rent these vehicles here, and for the most part, if it's going to drop, let's get in for 1 to 5 days, maybe 10 to 15 days depending on the opportunity, and then let's take it off ahead of expiration once our profit objectives have been met. But if you must hold to expiration, again, the strike minus the net debit will be your break even. This trade needs a big enough move to cover the net debit cost, because again, this is in the money, and so you need that big enough move. But again, that's only if you're holding to expiration. If price is pushing in your favor, then the price of the option will increase. Now, execute this strategy when you expect a high probability move lower, and it is not necessary to hold this trade to expiration, especially if your profit targets have been reached. So if your profit objectives have been met, take your money and run. Give yourself enough time in the trade, days to expiration, to be right. Ideally, 45 days or so is a good amount of time here for an in the money, but every situation is different. For example, if you really believe we're about to see a solid move, we had a rejection here and we're about to see a move back down, or there's a failed new high that happens here, and you're about to see an aggressive move downward over the next week, then you could use in the money options on a weekly basis with 8 or 10 days out up to expiration and be just fine. But you have to be more accurate in that sense. Again, by giving yourself time to be right, you don't have to be as accurate with your timing. And everyone has a different level of experience with how accurate they are with regards to timing and execution and trade location. Oftentimes when I see it and I know that that's the move, that's when I'll be a little bit more aggressive about it. If I'm iffy about the situation, then I'll start looking at other ideas here instead of an on the money option. But for the most part, you want to give yourself time unless you are very, very confident in that opportunity moving in your favor very quickly. Here's an example. Again, our handy example in Halliburton, moving to the 46s, seeing major rejection after rejection after rejection after rejection, and we get back to that level again. And remember, this one right here has a strike at 45 that we used for the the spread, the 40-45 put debit spread. But with this one, we're looking in the money, and the in the money 70 delta is the 47 half put. The 47 half put is somewhere up here, or maybe a little higher. And again, that's your in the money option. It's going to be a little bit more expensive here, $2.99 for that put. Again, that's your max debit. That's also your max risk. The max reward is unlimited to 0. Again, that doesn't typically happen, but in terms of the options in the theory, that's the potential. Break even right here, 47.5 minus $2.99 that you paid. So the 47.5 minus $2.99 gives you a 44.51 break even. So at expiration, price needs to be at or below this zone, the 44.51, in order to be break even or better. Again, with this one, there was 38 days to expiration, which is somewhere way over here. And so again, there's a lot of time to be in the money in that case. But for the most part, if this were to drop over the next 2 weeks or 3 weeks, you're going to be quite a bit in the money, and you want to take profits along the way. So again, you want to buy when implied volatility is low so that premiums are cheaper. You want to buy with 30 to 50 days to expiration in most cases, give or take, depending on the situation. Time decay, you got to know it works against this position, so you want to look to take partial profits after quick windfall moves, right? As soon as you get a big windfall move in your favor, you want to take those profits and take profits along the way. And again, look to take profits once your profit objective has been met. Do not be too greedy, because the market will humble you. We see it time and time again. Take what the market gives you. Take the money and run. Okay, so if you look at this again, you can see $2.99 in this case is what we paid to be in the 47.5 put. Let's see how this plays out at expiration. Okay, here we are. Well, this isn't quite expiration. This is when price hits our target objective, which is inside these two red lines based off of this high and average monthly range. Additionally, from rejection, bringing it back to value, which is composite VPOC. And again, that is a great trade each and every time. Taking price from rejection and returning it to value. A great trade. You take that trade over and over the course of your lifetime by buying below value and returning it to value, or selling above value and returning it to value. Over time, the odds will work out in your favor. So a great, great opportunity. Over here, we got in at $2.99, and you can see 14 days later, with 24 days left to expiration, that put, the value of it has now increased to $6.80. And so if you take it off right here for $6.80, once you hit your major profit objective, again, you're going to net $3.81. That's $6.80 minus $2.99. And that $3.81 over the $2.99 that you paid initially gives you a 127% gain on your money. Again, you want to look to take profits after that windfall move, right? And also, so the first major windfall moves are like this, you know, anywhere in here after this day and down here. All of that provides opportunities to take a piece of the profit as it continues to roll downward. So it's very interesting how this will play out, because oftentimes, you know, when market starts to really go in your favor, there's kind of a push and pull of, do I hold on and just be greedy and let, you know, I want to take off the entire position off at the target, or do you want to lessen some of that risk exposure, because now as price goes in your favor, you've built up quite a bit of profit in there, and you do not want to give it back. So it's always very, very important to pay yourself along the way. Should price close way in the money, allow the options to expire to avoid paying commission on the exit. Again, if price is way down and expiration is closing in, then that's good. In this case, there's still 24 days to expiration and we've already hit our target. Are we just going to let it sit there and close? Or sit there and die till expiration? I don't think so, right? Because now, again, you've gotten paid, you got the big move, and with 24 days to expiration, this drop only took 14. It could go 14 days right back up, and in another 14 days through it, or 10 days through it for 24. Again, you want to take the money when it's given to you. So again, great job on finding a rejection, great job on finding a retest entry, great job on identifying the in-the-money put, and as this thing pushes in your favor, great job taking profits along the way toward your final target. In this section, we are going to cover out-of-the-money options. Out-of-the-money options are options that are out of the money, which means the stock price is below the strike price for calls and above the strike price for puts, thus giving these options time value, but not intrinsic value. These options are cheap, and the farther out of the money they are, the cheaper the options become. These options are typically called lottery tickets because potentially explosive percentage gains can be had, but they are extremely risky and should be only traded sparingly and only when you know what you're doing. Again, just because something is very cheap, it might be 20 cents up here or 5 cents to buy a far out of the money option, and if price were to get to that price, yes, you're going to have a huge percentage gain, because if price were to rally from way down here up to here, the 20 cent option down here, again, that could turn into $2 by the time that rally's done, and now you've made 10 times your money. But again, you're going to make 10 times your money because the probability of that happening is so low. And so you have to know that. These are very, very risky. You have to use them accordingly. But the way that I engage out of the money options isn't necessarily super far out of the money. It's mostly slightly out of the money so that it lessens or reduces the cost of the trade. And again, you have to have a pretty good indication that price is going to go in your favor in order to do that. So here, out of the money options means the stock price is below the strike for calls or above the strike for puts, which leaves these options with time value but not intrinsic value, thereby making them less valuable and less expensive. The two that we're going to focus on: out of the money long calls, out of the money long puts, the bullish and bearish. Here, they're cheap. That's a benefit. They're cheap. It is not uncommon to pay pennies for out of the money options, and for good cause. The likelihood of price being in the money at expiration is quite low. So while they're quite cheap, the risk of losing the entire amount paid for the option is high, unless you are very right on direction and timing. Again, you have to be very, very right in order for these out of the money options to work out. Or you have to give yourself quite a bit of time in order to give that market time to prove you right. The percentage gain can be big. That's another big benefit of trading out of the money options. Because of the cheap nature of out of the money options, major percentage gains can be seen if price explodes in your desired direction. However, time decay hits out of the money options harder than their in the money counterparts. So exercise caution. You have to know what you're doing. Let's take a look now at out of the money long calls, which are bullish. The objective of using out of the money long calls is to execute a bullish trade when you are either extremely bullish or want a lottery ticket approach to a trade. This approach reduces the cost of the trade and also increases the potential return. However, this play is very risky because out of the money options do not have intrinsic value and have greater odds of expiring worthless, thus resulting in complete loss of the trade. So you have to be very careful again. Say, for example, here's your 100 strike. That's where price is trading. And out of the money would be, say, buying the 105. Right? So you have to be confident that price is going to get to 105 because you have to get above that level in order for that option to be in the money and worth something. Otherwise, if price stays at 100 and doesn't go anywhere, the value of this option will drop significantly with time decay, and it will go to zero very quickly. The same thing if you pick the 110 call or the 120 far out of the money. This one might be worth a nickel. And yes, if price were to go here, you might make a ton of money, but at the same time, the likelihood of that happening is not very high, thus the reason it's priced at a nickel. And so again, you can use that delta too to give you a percentage the likelihood of price closing in the money. A 70 delta in the money call would give you about a 70% chance that price will close in the money. But an out of the money, say 20 delta call, would give you about a 20% chance of being in the money. Again, not a great chance, so you have to be very, very careful. Now let's take a look at some of these characteristics here. Number one, this is bullish, right? It's an out of the money long call. Because it's a call and you're long, it's a bullish strategy. The asset legs is a long call. You're long calls and they're out of the money. When to use? When you are extremely bullish or you want a lottery ticket approach. Say, for example, price is consolidating, but earnings is coming up tomorrow or after the bell today. Well, in that case, you might think that price is about to pop up pretty sharply. Say it's 110 right now, you think it might go to 120 or beyond, and then earnings hits and pow, it opens up at 130 and starts to run. You just turned a very cheap trade into a big, huge winner. And again, that's why it's a lottery ticket, right? That is not always a very easily achievable scenario, but it can happen, and there are scenarios where this is a really good approach. So that's what I mean by a lottery ticket type of approach. Profit characteristics: the profit increases as the market rises with unlimited profit potential. The loss characteristics: is the max risk is the amount paid for the calls. And again, that's likely to be cheaper because they are out of the money. The decay characteristics, time decay erodes the value of out-of-the-money options at a much higher rate than in-the-money options, or any of these strategies, for example. Any of these strategies, you're not going to see a significant hit like you will with out-of-the-money options with time decay. With exceptions of perhaps the straddle, the long straddle, right? The long straddle is another one where you're double long premium and time decay will hit that one. Well, this is out of the money and it's a similar concept. If it's super out of the money and time is whittling away and price is over here and you're hoping that the thing will go way up here, the likelihood of that happening is very low. So again, the value of that option will drop significantly. So again, time decay erodes the value of this option at a very high rate. And so you want to be able to take your profits if you get paid. If price pops in your direction like you want, you got to take profits. You got to take some off the table because that can be whittled away very, very quickly. In terms of max risk, it's capped because it's capped to the amount you paid. And the max reward is unlimited because theoretically speaking, it can go to the moon. Now in terms of the strategy, you want to use this strategy when you are extremely bullish. Extremely bullish. Again, out of the money long calls. You want to go slightly out of the money to reduce your cost basis. So sometimes, for example, if we have a great rejection day here, and say this is 100 and this is 105 right here, then sometimes I'll go out of the money 105, whereas my entry point might be 100 at the midpoint here, and I'm hoping that over the next 2 to 3 weeks it makes a move through that 105 high and continues through it. So that's a way for you to reduce your cost basis. If you go say 120 delta, then yeah, that's not going to be worth a whole lot, and your likelihood of getting there is going to be very low. So that's why I say with out of the money options, I'm usually using slightly out of the money options versus the far out of the money options, unless there is a significant scenario in which I want to take that long or far out of the money option. For the most part, I am slightly out of the money. So go deep out of the money when you want a lottery ticket approach to a trade. Again, ahead of earnings or something like that could be one of those scenarios. The cost of the option will be cheap, which carries less risk capital, but the deeper the out of the money, the more risk is incurred. So that's something very interesting because again, say you're at 100 here and you got the 120 deep out of the money call. Again, it's going to be cheap. So it carries less risk capital, so it's cheaper, but it is more risk involved. There's more risk involved the deeper in the money because the likelihood of that being in the money at expiration is very low, which makes it very risky. So even though the capital requirement is low, the likelihood of that closing in the money is also very low and thus risky because you can then lose your entire premium that you paid for that far out of the money call. Give yourself enough time to be right. Again, 45 plus days is a good amount of time. Sometimes, for example, you want to take, a 3 to 4 month type of trade, then you can go a little farther out, 100, 120 days out. But again, for the most part, every situation is a little different. Most of these swing trades that we're taking in this course here would revolve around a 1 to 3 week time frame in terms of duration of trade, and this is a really good amount of days to expiration to execute something like that. Max risk is the amount paid for the option, and again, with out of the money, you want a quick move in your desired direction. Otherwise, time decay will start to whittle that value away from that option. All right, let's discuss the out of the money long call example now. Execution, you want to buy the out of the money long call options 30 delta or lower when the price of the underlying reaches your entry trigger. Now this isn't a hard and fast rule compared to the 70 delta. 70 delta is a much better idea. The 30 delta or 20 delta, for example, again, that's a good zone here depending on the opportunity. Sometimes that's not what I'm doing because sometimes I just want to be slightly out of the money to reduce cost basis. So that would be maybe a 45 delta or something like that, or maybe even a 50. But overall, 30, 20, that's about as far out as you go sometimes, but every situation is different. Now in terms of the actual example, say XYZ is trading at 100, and you believe that price has the potential to see a major upside move to 115 or beyond. So here's 100, and you think it'll get as high as 115. So in this case, you may buy the 110 call. Here's the 110 call right here. This is the 105. And so you buy this one for 35 cents. This one might be 5 cents. This one right here might be, say, $1.50. And this one at the money might be, say, $2.75, something like that, right? And so by buying the out of the money 110s, you're betting that price is going to make its move higher and rally toward 115, which is your target idea, and now you'd be in the money by, say, 5 handles, or 5 points, something like that, right? And so for the most part, you need price to close beyond the 110 strike that you bought at expiration plus 35 cents. So price needs to close beyond 110.35 for a break even in that scenario. However, that's at expiration, right? If price is rallying before expiration and it's 105, it's 106, and it's approaching your 110 that you bought, this 35 will increase to 40, and then 60, and then 80, and then it might be $1 in the money. And so it doesn't necessarily have to go through 110 or even to 115 for you to make money if you put the trade on at 100 and it's going higher. However, the closer you get to expiration and the longer that price stays below 110, that price and value of that option starts to go down because you're not getting to 110. So again, there's a balancing act here. And so again, I'm not usually looking to hold these to expiration. I'm looking to rent this and take that off the trade, take that trade off the table once price pops in my favor to my desired target. So 35 cents is the premium bot. That's also your max risk. Your max reward is unlimited, and your break even is going to be your strike plus the net debit paid. So in this case, 110.35. So execute this strategy when you anticipate a potentially explosive move to the upside, but would rather risk the small debit paid, like a lottery ticket. You typically want to see price move in your desired direction quickly. Otherwise, time decay will begin to erode this position. It is not necessary to hold this trade to expiration, especially if your profit targets have been reached, and give yourself enough time in the trade, days to expiration, to be right. Ideally, 45 plus days to expiration. Let's take a look at an example. All right, here is Win Resorts again. A great rejection day down here. Again, not every time do you need to go super far out of the money. Again, that's way too far out of the money. Sometimes I just want to be slightly out of the money so that when price hits my entry point and we get a nice little rejection day trade sequence, and then all of a sudden we start getting paid, we're now through the 165s and working toward our target. So in this case, what we're looking at is the 165 call, slightly out of the money. It costs 222 when price hits this zone here. So 222, that's your net debit risk. Your max risk is 222, your net debit is 222, your max reward is unlimited. And so since you bought the 165 strike, you have to add to it your debit, and that's your break even at expiration. Again, we're not looking to hold it to expiration in most cases, but at expiration it needs to be beyond that point in order for you to be break even or better. So again, the objective of using out of the money long calls is to execute a bullish trade when you are extremely bullish, but you want to reduce the cost of the trade and or improve the potential return. Out of the money options have no intrinsic value and thus have greater odds of expiring worthless, which makes them very risky. I have to stress that. It makes it very risky to trade out of the money options, especially the farther out you go, unless you are very right, unless you get very lucky with a huge pop in your favor. Because again, if price doesn't go to and through 165, the value of that option that I paid will start to whittle away very quickly with time decay. So again, you just have to be very careful with out of the money options because you can lose the entire premium if you're not right. Tips: buy when implied volatility is low. Buy with 30 to 50 days to expiration, so you give yourself time to be right. Time decay will work against this position, so look to take partial profits after a quick windfall move. So if the next day you get a quick pop up above 165, that's probably the best spot to take some partial profits because you've now taken this trade $5 higher and into the money. That's a great time to take at least a partial profit. And then as price continues in your favor, look to take those gains as well. So again, here's your 165 call. You add to it 222. That gives you 167.22 as your break even. Your entry is somewhere right here. You need price to go to that red line or higher by the time expiration comes around. But in most cases, we're trading 30 to 50 days out, and we're only looking for about a 10 to 15 day move up. And so expiration is still going to be way, way out there. And so we're just going to want to take that off and not leave it to expiration in most cases. Again, anytime you get a quick pop in your favor, take profits and look to take profits once your profit objective has been met. This is what it looks like here now when price rallies significantly. Remember, the out of the money 165 call was 222, and then several days later at expiration, price closes 184.73. 184.73, so that's basically in the money from the 165. It's 19.73 is what the 165 call is worth at that point in time. Almost 20 points, right? 165, 185, basically. So about 20 points. It's actually 1973. So you take 1973, deduct the amount you paid. That gives you 1751 as your net gain. Now again, the percentage on this is going to be much bigger. Look at that, 789% gain. And so you can see that as we've progressively gone to more risky from our strategies, right? From credit spreads to debit spreads to neutral strategies to in the money to out of the money, it's progressively increased in terms of the potential return on your money with the same exact example. And that's why it was important for me to use the exact same example time and time again for this so that you can understand where to engage these, which ones to use, and how the final product looks against the other opportunities. So a big time move when this thing popped higher at expiration, 184.73. That's a 789% gain over the 222 that you paid. That's a huge move and an awesome trade. And again, this was just using slightly out of the money options. Imagine if we had traded the 170 option and paid $1. Maybe we went 175 or 180 and paid a nickel for something, and now it's worth $5. Again, that would be a 10 times your trade type of trade, 10 times your money type of trade, and that would be huge. So again, the farther out of the money you go, the bigger the potential return on your investment if price actually pushes into your given or favored direction. Great, great move, great rejection. And again, slightly out of the money is usually the way I go. And even in this case, $5 out of the money, and then a nice continuation higher. Let's discuss out of the money long puts now. The objective of using out of the money long puts is to execute a bearish trade when you are either extremely bearish or want a lottery ticket approach to a trade. This approach reduces the cost of the trade and also increases the potential return. However, this play is very risky because out of the money options do not have intrinsic value and have greater odds of expiring worthless, thus resulting in complete loss of the trade. Again, puts, and we're long these puts, that's a bearish bet. The asset legs are just basically the long put. And then down here, when do you use it? When you are extremely bearish or want a lottery ticket type of approach to a trade. Also, the profit characteristics, profit increases as the market falls with unlimited profit potential, at least to zero. The loss characteristics, max risk is the amount paid for the puts, so your debit will be the most that you can lose. Decay characteristics, again, because this is an out of the money option, time decay will erode the value of this option at a much higher rate than the in the money options, especially the closer price gets to expiration and price remains out of the money. That value is going to whittle away very, very quickly, so keep that in mind. Max risk is capped to the amount paid for the long put, and the max reward is unlimited to a stock price of 0. So the strategy here in this case, use this strategy when you are extremely bearish. Go slightly out of the money to reduce your cost basis. Go deep out of the money when you want a lottery ticket approach to a trade. And the cost of the option will be cheap, which carries less capital risk. But remember, the deeper out of the money, the more risk is incurred because the probability of closing in the money is very, very low, and thus you can lose the entire premium that you paid for that option if you're not careful. Give yourself enough time to be right, something around 45 plus days to expiration. Your max risk will be the amount paid for the option, and again, you want a quick move in your desired direction, and you want to be able to take profits on the first major favorable pops in your direction. Let's take a look at an example. So execution, buy the out of the money long put options 30 delta or lower when the price of the underlying reaches your entry trigger. Out of the money long put example here, whenever price is trading at 100 and you think that price is going to drop down to 85. So maybe you buy the 90 out of the money options. The 90 out of the money options may be 35 cents here. You buy them up here, and then if price drops in your favor, you're going to get rewarded very, very nicely. If price doesn't go down or maybe goes up, the value is going to whittle away very, very quickly, especially the closer you get to expiration. So in this case, the net debit is 35 cents for the premium bought. The debit paid, 35 cents, is also your max risk. Your max reward is unlimited to a price of 0 for the stock or the underlying that you're trading. Break even is when the strike price minus the net debit, that's going to give you the 89.65 in this case. So again, if you bought the 90 put, subtract 35 cents that you paid, and that's your 89.65. So again, you need to close at or below that level at expiration in order to break even or make a profit. Here, execute this strategy when you anticipate a potentially explosive move to the downside, but would rather risk the small debit paid, lottery ticket, than pay a larger premium. You typically want to see price move in your desired direction quickly, otherwise time decay will begin to erode this position. It is not necessary to hold this trade to expiration, especially if your profit targets have been reached, and give yourself enough time in the trade, days to expiration, to be right, ideally 45 plus days to expiration. Let's take a look at an actual example. Again, taking a look right now at Halliburton, you can see right here your 46 resistance level. That's been very, very important. This is a slightly out of the money put right here. Slightly out of the money put, 45s. Again, if you did something like, a 42 half, right, then that's going to be much, much cheaper than the $1.38 that's paid for this one. So again, the deeper out of the money you are, the cheaper it is, or the deeper out of the money, right, or the farther out of the money, the cheaper it is. But it's also the probability increases that price will not reach that zone. So less odds of reaching that area, which means that you could potentially lose that entire premium. So you got to remember that the objective of using out of the money long puts is to execute a bearish trade when you are extremely bearish, but you want to reduce the cost of the trade and or improve the potential return. Out of the money options have no intrinsic value and thus have greater odds of expiring worthless, which makes them very risky. So you have to keep that in mind. Now if we take a look at this example, over here, 38 days to expiration, you buy the 45 put for $1.38. That's your net debit, that's your max risk, and your max reward is if price drops to 0. Not likely to happen. All we want is for price to go into our high probability target zone or back to value. The break even in this case is going to be your 45 strike minus the $1.38 that you paid, and that gives you 43.62 as your break even point. So you need price to at least drop here by the time expiration arrives 38 days later. Again, we're not looking to hold to expiration, but you have to know when and where the break even is. So the break even is here by the time expiration comes. Otherwise, for the most part, we're just looking to engage this trade over the next 5, 10, 15 days, and then we're going to look to take it off once our profit objectives are reached. Let's take a look at how this played out. So again, price hits the midpoint at 45.50, so this is just slightly out of the money. Only 50 cents out of the money at that point, and then price drops significantly through the break-even point and continues into our target zone down below. By the time price reached our major target down here, the value of that out of the money option had ballooned up to 440, and that is a 219% gain, because you made $3.02 after subtracting your cost, and 302 divided by your 138 gives you 219% gain on your money there. So a pretty solid move. Again, out of the money options are an aggressive play that should only be used when a high probability opportunity presents itself and when price is looking to make an immediate move. Additionally, you may want to play out of the money options, especially farther out of the money options, if there is some sort of news event coming or maybe some earnings, and you could play it in that way. But again, that is a recipe for losing your entire premium if the trade doesn't play out the way you intended. So again, a lot more risk despite the fact that the premium is smaller. Over here, look to take profits after a windfall move. Look to take profits once your profit objective has been met. And should price close way in the money, allow the options to expire to avoid paying commission on the exit. Again, I would only do that if expiration is near. For example, over here, expiration is still another 14 days out, rather 24 days out, and so that's a lot of time not to take your profit. So again, anything can happen in that much time. Anything can happen in just a few days. So take your money when you have it, but if you are deep in the money and expiration is within, say, 2 or 3 days or maybe a week, maybe that's an okay time to allow it to expire to avoid paying commission on the exit. Okay, in this section we are going to discuss trading the underlying. While trading the underlying isn't necessarily an option strategy, sometimes it is the appropriate strategy for the specific opportunity presented itself. In this section, you'll learn the benefits of trading the underlying, buying and selling shares, contracts, and stocks, futures, etc. versus trading an option strategy. Additionally, you'll learn how to generate income from a position and how to hedge a position using options. So trading the underlying is at the very bottom of our section here, and so again I would characterize this as the most risky just because there's more capital at risk at this point. But this is a way for us to mitigate that risk by using covered calls, protective puts, and collars. So those are the three strategies that we're going to be used. One is income, one is hedging, the other is hedging as well. And so while trading the underlying again isn't necessarily always beneficial because options provide so many benefits, oftentimes it can be the appropriate approach for longer term trades and some of these other scenarios. So let's discuss this a little bit more here. Benefits of trading the underlying, easy to understand, right? Very easy to understand how to buy and sell a stock. Trading stocks and futures is much easier to understand than trading options, which makes for an easy transition for beginners, as options can be complex to understand at first. right? So again, buying and selling a stock, very straightforward in terms of being easy to understand. The other point here is liquidity. Liquidity is very important. If there's no liquidity, you can't place a trade. You must have volume and liquidity in order to execute your bias in a market. Volume and liquidity tends to be much higher and much better in equities and futures markets versus the options markets, which is extremely helpful in getting filled on entries and exits. Again, if you can't get filled, you can't place a trade. So you must have liquidity, and generally speaking, stocks, futures will have much better liquidity in terms of compared to options. Now, there's no time decay or constraint. That's another, perhaps the bigger and the bigger of the benefits is this one. There's no time constraint on the position, which allows you to hold on for longer periods of time as the markets may trend for months or years. So again, if you're buying something as a long-term investment, you can hold it for the period of 1, 2, 3, 5, 10 years, and hopefully price will continue to trend in your favor. Whereas with an option, again, there is a time constraint, and at some point it will end. So again, there's many different benefits here to trading an underlying, and so again, that's something we do in our trading room, where there are longer term trade ideas that we may want to execute. So we buy shares in the underlying, and then I will then look to use some of these option strategies to help either generate additional income or to protect myself in some circumstance. The first strategy that we're going to talk about is the covered call strategy. Very simple strategy, covered call. Basically, the objective of using a covered call strategy is to generate income from a long position in the underlying that you intend to keep for the long term, but are willing to sell if the underlying reaches a specific price, the call strike price. So for example, in this case, your direction is bullish because you are long an underlying, you are long a stock or long futures, you're long an ETF, you're long, and you are bullish. The asset leg, you have to be long the underlying, so you have to have shares, and then you are short out of the money calls. So you are selling premium on out of the money calls there. The idea is that you will generate income by selling these out of the money calls week over week or month over month. By selling those calls, you're making a little bit of money time and time again. But if price were to push through those short out of the money calls, you may be asked to call those shares, right? Someone may say, hey, I want to now be long from the spot where you sold it, and then you would have to give up your shares in that case. So you have to be okay and willing to sell the underlying if that strike price is taken out. But ideally, you will sell a strike just far enough out of range that if price were to go higher, it would still expire worthless. You get to keep the premium, and you get to do it again the next week or the next month to continue to collect your premium. Now, when to use it? You use this strategy when you are long shares or contracts of an underlying and want to generate income by selling premium. The profit characteristics: you retain the credit if the call options expire worthless. This is the ideal scenario for this trade if you're wanting to generate income. And again, the decay characteristics: time decay erodes the value of the out-of-the-money options at a much higher rate than in-the-money options, which is very helpful for this trade. Remember, you're selling premium. And since you're selling premium, time decay is very, very helpful for your trade. Max risk is the credit received minus any downside risk from owning shares or contracts. So basically, downside risk is the credit received minus any downside from the stock, right? So if you sell out of the money calls out here, you may get that premium, but stock price may drop, and so you're going to take some risk here on the price of that stock. But again, you're intending to hold this stock for the longer term. So again, that should be okay as long as price remains above your market structure levels. Max risk and max reward here. So max risk is anything related to the downside of the shares. The max reward is capped to the credit received plus any potential gains from the share assignment. So again, if price pushes to your sold call and you are assigned to sell those shares there or give them up, then you will have made any gains from when you've been holding that position plus the credit received in many cases if price were to trade below. So it depends on how it plays out. In terms of the strategy here, you use this strategy when you are long shares or contracts and want extra income. You use this strategy after you've enjoyed a profitable move and are okay with selling your shares or contracts should the sold strike price be reached and assigned. You buy shares or contracts and sell calls at the same time. You can do that, and that would be called a buy right. So if, for example, say you're going to buy 100 shares of a stock at $50 a share, you could simultaneously sell the 60 calls and collect premium, and that will lower the cost for that trade. You have to be okay though with price going up to 60 and then having to give it up at 60, but you make a clean 10 handles there, right? So again, that's called a buy right. That's something that I like to do as well. If you buy shares of an underlying, go ahead and sell some calls up above, and again, that right there will lower your operating costs there on the actual trade. You also collect a little premium and income, and then you can look to do it again the next week or the next month, depending on if you're selling weekly or monthly options. In this scenario right here, you buy shares contracts at the same time, that's a buy right. But if you sell far out of the money calls to generate income, this will lessen the odds of assignment. So again, the farther out of the money that you sell these calls, the less likely you will be assigned, but also the smaller the premium you will collect. So it's a balancing act of what you think can happen. And also use the strategy with weekly and monthly options for generating income frequently. So if you hold shares in a stock, you can sell options every single week and every month and make additional income from selling those options because you hold the shares. So you're selling these by themselves, but they're not naked because you own the underlying. If you didn't own the underlying, I would not be selling these out of the money or selling anything without having the proper protective measures in place. So again, you have to keep that in mind. So I remember learning this strategy so far ago when I took a Series 3 course, and the instructor said that this covered call strategy is one of the easiest strategies around, and he called it the grandma strategy because grandmothers everywhere that own shares from so long ago in their portfolios constantly sell premium, those out of the money calls, because they never intend to sell their shares, but they'll sell out of the money calls every month and just collect a small income that way. So again, a very good way to collect income even if you don't trade but hold a large portfolio of stocks. You can collect income in this way. So here is an example. This is Roku. Again, Roku right here at $30 a share. $30 a share. Major stop run day trade sequence. Recall I was in on that bar right there, and the idea at the time was that $30 CLVN was sharp. It was a major market structure level, and the idea was that we could rally toward 52 over time. And then when the market was ready, we may even see a double going from 30 up to 60. And so in this case, if you are core long Say you're long 1,000 shares from 31 bucks, right? Because you have your stop run day sequence here. See that stop run day right here? And then look at your absorption point here, holding at 31, 31, 31. Say you're long 1,000 shares from 31 bucks. Okay, and you've been holding forever. You've been holding this entire time, and now price is at 47.22. You say, you know what? I could sell the 55 call. I could sell the 60 call. I'll get 65-cent credit on the 55 call. I'll get 24 cents credit on the 60 call. And again, your idea is that, yes, price may go up here, but I'm looking to collect some income. But if I am assigned because price blows up and goes through those calls, I'm okay selling it up here at 55 or 60 because I've been in since, say, 31, right? And so again, this is what you'd like to do. And you can do that month over month, right? As soon as you hold this one, you could be selling, say, 44s, and if price, doesn't get there, you collect that premium, and then you do it again. I'm going to sell 48s, and if price doesn't get there, you collect the premium. You do it again. I'm going to sell, say, 52s, and if price doesn't get there, you collect the entire premium. Now you do it again. I'm going to sell 55 or 60. I collect this credit, sell that premium, right? And then if it doesn't get there, again, I can do it again. Or if it does get there, then it takes me out of my trade from a 31 position, and now I've made quite a big amount of money. So let's cover this again here. The objective of using a covered call strategy is to generate income from a long position in the underlying that you intend to keep for the long term, but are willing to sell if the underlying reaches a specific price, the call strike price. Now, if you're not willing to sell it, say you're in Roku and you're like, I'm a lifer, and I want to hold this until it gets to, say, 150, then sell farther out of the money. Because the farther out of the money, the less likelihood that that's going to be assigned and reached, but you will be getting a smaller credit as well. Tips. Sell calls when implied volatility is high to collect more premium, like before earnings. Sell farther out of the money calls if you don't really intend to sell your shares, right? That's right here. And lastly, sell closer out of the money calls if you've profited quite a bit in the underlying and are ready to exit the position. So say I've been long since 31s. I'm ready to go ahead and take this off on one more big pop up. I could sell a closer 55 or maybe a 52, and that gives me a bigger likelihood of being in the money and being allowed to sell my position at that point. Execution. You're long shares from 31 and want to generate additional income by selling out of the money calls at 55 or 60 with earnings due after the closing bell. So earnings is up next. If the strike is reached and the calls are exercised, you must be okay with selling your shares in the underlying if they are assigned. Example, long 1,000 shares from $31. So because it's 1,000 shares, you got to sell 10 contracts. Remember, each contract is 100 shares. You need 10 of those in order to make 1,000, and you own 1,000 shares, right? So you got to do as many as you need to cover that. Now, it doesn't have to be all of it. Say you do 5, you can do 5 contracts. But if it's reached, it would only take you out of 500 shares, and you would still be long. So again, as long as you are selling what you have or less, it's okay. But you cannot sell more than 10 contracts because then those would be naked, whatever's left over, and that's not a good thing. Over here, you're going to sell 10 of those August weeklies, 55s for 65 cents, right? So you're going to make 650 bucks net credit. That's your income. That could be weekly income. That could be monthly income. In this case, this is 2 days out on the weekly because you have earnings. And so 65 cents, you're able to make 650 bucks net credit. If price doesn't close beyond 55s, you collect the entire 650 and you get to do it again next week or next month. If price closes beyond and you are assigned, then you're going to give it up at 55. And then over here, it'd be 55 minus 31 would be your gain of 24 handles plus the amount you collected at 650. So it'd be 24 handles plus 650 if this thing is assigned. So again, your max risk here is the 65 credit minus any downside risk from being long the 1,000 shares. Your max reward is the 65 credit plus the 1,000 shares at 24 points from the stock position. So if price were to hit that 55, our max gain would then be 24 points from the point of our entry. Okay, let's see how this plays out. Okay, here we are. Earnings comes out, and bang, this thing smacks through, pushes through the 52s, and rallies significantly. It goes through the 55 call and closes around 58s, right? And so it is beyond the 55 call. So you collected at 650, but at the same time, you may have to give up your shares if you are assigned. So in this case, the value of 10 at the 55 at expiration is 310. The net gain in this case is 65-cent credit plus the 10 contracts, or times the 10 contracts, that's 650. And then over here, the 1,000 shares times 24 points gained is 24,650, and so that's your max gain right there, because again, you were long from here and you're giving them up at 55. So the covered call strategy offers a great way to book consistent income weekly or monthly from a long-term position in the underlying. This strategy offers a low-risk approach to squeezing out extra profit from a position you already intend to hold, but are happy to book profits on if your sold strike is reached and you are assigned. And so again, the tips here: use this strategy weekly or monthly to squeeze more income out of each expiration cycle while you're holding a long-term position. Also, use this strategy at the entry of a new long-term position in the underlying in order to reduce the upfront cost by collecting the credit of the sold call. Remember, that's called a buy right. So for example, this point right here can be used here. Say we bought here, right, as I did. Say we bought here, say we bought there, wherever at the 31. Whenever you bought it, you could also have sold the 40 strike, for example. And if you sell the 40 strike, again, that's going to lessen your cost. You sell the 40 strike up here and price doesn't get there, you collect that net premium and you're still holding your long-term position, right? And so again, that's called a buy right, doing it right at the outset. Over here, let's look at our current example. A major beat on earnings in terms of forward guidance, a major continuation higher. The options are exercised. Roku beats on earnings, triggering a rally the next 2 days. With price closing at 58.10, the sold call is exercised, and we must sell our 1,000 share position in the underlying for 55 bucks, given the trade a 24-point gain, right? The alternate option: had we chosen the 60 call, it would have expired worthless. We would have retained the 24 credit, and there would be no need to sell the 1,000 share position in the underlying, right? So again, depending on which strike you chose, you may still be holding on to that position, or you could have been assigned and had to give up your 1,000 shares. But the point of this exercise is, if you are core long a position and you think that this is going to continue higher, at the very beginning of that trade, you can do a buy right to lessen the cost of your trade by selling some farther out of the money option. And then you can continue to do that week over week and month over month as this thing continues to go higher until you're ready to take it off. So again, a great way to engage a long-term holding in an underlying while being able to continue to collect additional income. Again, you got to be able to squeeze out any amount of money you can from this market, and milking it using this type of income strategy here is a very good way to go. However, you have to be okay with giving up your shares if you are assigned. And so if you're not okay with that, then I would sell farther out of the money options, just in case. You'd be collecting smaller income, but at the same time, you are more likely not to be assigned, and you're more likely to keep your underlying position. All right, let's take a look at a protective put. The objective of a protective put strategy is to protect a long position in the underlying against a downturn. Execute this strategy when you intend to hold a position in the underlying for the foreseeable future, but you want to protect profits in the event of selling pressure ahead of news or earnings. Again, earnings, every quarter we're going to get earnings, and if you're core long a position and earnings comes up, it's a good idea to put on a protective put strategy if you are nervous that perhaps some of your profits may be taken away. Again, this is a very good way here to protect yourself. You can use stops, but again, this is a much more foolproof way to use a stop. It may be a little bit more expensive, but stops don't always work. And so again, this is a great way to use a protective stop when you are long the underlying. So in terms of direction, this is a bullish trade because you're long the underlying and you want it to continue to go up. However, earnings is after the bell or maybe next week, and just in case you want to buy, say, an out of the money put. You want to buy this put just in case this happens, or just in case a gap down happens, right? And then you would be able to exit that position wherever you bought the put. And so again, right here, whenever you are in a protective put strategy, you have two asset legs. You are long the underlying, and then you're long an out of the money put. And out of the money put is when price is below, the put is below the current price. When to use? It's when you're bullish but want to protect your downside. The profit characteristics: profit increases as the market rises with unlimited profit potential. And the loss characteristics: max risk is the amount paid for the puts. Decay characteristics: time decay will negatively affect the value of the option, right? So it's out of the money put that you bought. And so if price never gets there, that value will whittle away on the option. And for the most part, that's a good thing. Remember, this is just a protective put. You want to stay long. You don't want to have to use it. And so buying out of the money makes it cheaper. But you also know that if it doesn't get used, the value of that option will go down. But that's okay, because ideally you don't want to have to use it. But if you do, again, it's going to give you a great way to exit a trade in a bad circumstance. Say, again, on missed earnings and you get a huge gap down the next morning, right? You'll be able to get out way up here instead of feeling the pain like the broader market. So right here, the max risk is capped to the amount you paid for the put. The max reward is still unlimited because even if the put goes to zero, your stock price can still go to the moon. Strategy: use this strategy when you are bullish and want to protect gains from a downturn. Buy out of the money puts to reduce your cost basis. Buy at the money or in the money puts if you are confident and want to profit from the downturn. That's a different one, okay? So say you're long, but you believe that price will go down sharply. Instead of buying an out of the money put to protect your position, you can buy an in the money put or at the money put to actually profit from that leg. Again, that would just basically be right here, the in the money put. And so that would be a way for you to make money as price is going down while you continue to hold a position in the underlying. And again, as this position pulls back, you may be able to add back to that trade overall. So that would be when you're confident and you really believe that price will push down, so you want to profit from that downturn, you can buy at the money or in the money. But classically speaking, a protective put is like usually an out of the money put below current price. Ideally, Price will rally enough to cover the cost of the protective put, or price will sell off enough to capitalize on the move using the bought puts. This strategy is a better, although more expensive, alternative to using stop orders. Again, if you use a stop, there's no guarantee you're going to get filled, especially in a flash crash event. But if you're using a put to protect yourself, there is a guarantee that you will get out at that put, even if you do have a flash crash event. So again, a very good way to protect yourself. Let's take a look at an example. This is Blue Apron. Right here, the objective again is using a protective put strategy to protect a long position in the underlying against a downturn. Execute this strategy when you intend to hold a position in the underlying for the foreseeable future, but you want to protect profits in the event of selling pressure ahead of news or earnings. So in this case, I was long 3 and just below 3, looking for a bounce back. This was a nice rejection day sequence at a great LVN, great market structure level. The problem is we have earnings in a couple of days. Earnings could be good and this thing could pop, or earnings could be bad and this thing could drop. So again, this is one of those situations where you can do a buy right. You can buy here because you think that this thing is going to go higher over the long term, but because the earnings is coming out in a few days, you want to buy a protective put just in case. And so again, many different ideas here, but for the most part, you're long shares in the underlying from $3 a share, and you want to protect the position by buying at the money puts at the $3 strike ahead of earnings in 9 days. In this case, the at the money put was worth 30 cents. So if you were long, say 1,000 shares at $3 right here, you can also buy right, where basically you're going to buy that put for protection just in case and ahead of earnings. And if price were to drop on earnings, you can then exit your trade at $3 and basically only pay commissions, or you can take profits on that put and then add back to your trade because you want to hold this longer term. So many different ways to go. And so again, you want to buy a protective put ahead of earnings, but look to buy the option 5 to 10 days ahead of earnings, because options will become more expensive as implied volatility increases the closer earnings gets. So you don't want to be waiting the day before earnings to be putting on a protective put, because by that point everyone's done it and now the prices are very expensive. So you want to do it, a week or two ahead of time. And in this case, 9 days out, that $3 put was 30 cents. Again, because there's 1,000 shares, you got to buy 10 contracts in order to make 1,000 shares. And you're going to pay 30 cents times 10, which is $300. So it's costing you $300 for the stop if you use it as a stop, but at the same time, it is a much more well-defined stop. The others are free, and they're free for a reason. So in this case right here, your max reward is unlimited, because even if the stop were to, or the protective put here were to expire worthless, theoretically this can go to the moon, and again, that's unlimited reward over the long term. And again, tips. You want to buy a protective put 5 to 10 days ahead of earnings, because they're going to get more expensive the closer you get. You want to buy the at the money or slightly out of the money puts to reduce cost basis. And you buy an in the money put if you are confident price will move lower and you want to profit from the move. So if you think price is about to drop, then perhaps you can go in the money. There's a $3.50 in the money put, and there's also the $4 in the money put, for example. Or that's $3.50 here, the $4. Any of those could be used if you wanted to profit from the trade significantly. Okay, so let's go ahead and take a look at how this plays out. So here in this example, again, this isn't a real example that I've used from my own trading. As embarrassing as this might be to look at, again, buying 3 or buying just below it, and then having to use a $3 put to protect myself against this type of earnings breakdown. And even before that, price dropped ahead of earnings like someone knew something, and then bad earnings and price drops, gaps down, and basically is worth $2.16 at that point. So again, by buying the $3 put, you can now say, you know what, I'm going to exit my 1,000 shares at $3 and be out of it. Basically less commissions and less what you paid. Or you can take the profit on the put and continue to be core long that position or add to the position. And again, by taking that put, you're able to offset the loss by a little bit, and over time, that helps you recoup much, much faster if you continue to hold this for the longer term. So in this case, there was failed absorption. Price drops through the absorption zone and sells off ahead of earnings, and then gaps down on the earnings announcement, closing the week 84 cents below the $3 strike. By buying the put, you are able to offset most of the losses in the underlying. So again, here's the example. We're long 1,000 shares from $3 in this example, and then price drops 84 cents. That gives you an $840 loss on the underlying by itself, not to even talk about the put just yet. The value of the August 3rd put at expiration is now 84 cents, whereas before we bought it for, remember, 30 cents. So we made 54 cents on that move. Times 10 contracts, we made $540. $540. So we lost $840 on the underlying. We gain $540 on the put, and basically the difference there is the $300 or the $300 that we paid, right? We paid $300 because it was 30 cents times 10 contracts. That's $300. And so that's not a bad deal. You only lose $300 when normally most folks would have lost $840 on that deal. So you can offset that by using that protective put. You could also exercise the put and be out at $3, and so you can get out at break even if you wanted. But again, this was a position designed to hold for a very long time, and in this case, you can take this money and run. You can average down, and now again be on your way. So this is a way where you can use a protective put in many different ways in order to mitigate your loss. You can also, again, all the various ways that you can take advantage of this. You can choose to allow the put option to expire in the money and collect the gains to offset the decline in the underlying. Again, that would be $540. You can choose to exercise the put at the $3 strike, which allows you to sell your 1,000 shares at $3, and now you're out basically break even, less the cost of the put, less the cost of commissions and those types of things. Or if price were to have closed above $3, say earnings were great and price popped up to $4, then you can choose to allow the option to expire worthless, thus avoid paying the commission on the exit and only taking the 30-cent loss on the put while capitalizing on the rally in the underlying. So again, those are the various ways that you can engage this type of opportunity. So it gives you a ton of flexibility, and all it is one put, because you are long the underlying. So again, this is various ways to engage this type of opportunity. Again, if you wanted to, you can buy these at the same time. I did not buy them at the same time. It was later. But for the most part, by buying at the same time, you can just have that built in right away. And if you saw an adverse excursion or adverse move here, then again, you're protected in some way. So again, a great example on how to take advantage of a situation despite the fact that price goes against your underlying. A great way to protect the underlying, a great way to go ahead and offset some of those losses, and again, a great way to protect your underlying with the protective put. Now the last one we're going to look at here for trade the underlying is a collar strategy. This is a hedge. The objective of using a collar strategy is to protect a position in the underlying by buying puts ahead of news or earnings, while simultaneously selling calls to help offset the cost of the bought puts. You must be okay with selling your shares in the underlying if the calls are exercised, however. This is bullish because, again, you are long the underlying and you want to hold it for the longer term, and so you believe that price is going to continue trending higher. The asset legs are the long the underlying, which you're long shares or contracts. You are long out of the money puts and also short out of the money calls. So basically, say you're long from 50 bucks, you can sell, say, the 60 call, and then you can also buy, say, the 45 put. So buy the 45 put in case something like this happens, but to offset the price of this put, you sell this call. And so now you're reducing your cost basis. However, if price were to rally through 60 and you're assigned, you now got to sell at 60, but you own from 50, so that's okay. So that is the gist of this trade. And so here, bullish, you're long underlying and long out of the money puts and short out of the money calls. When do you use it? When you are long shares and contracts of the underlying and want to protect the current profits, but are willing to part with the trade if the calls are assigned. So you got to be willing to give up your shares in the underlying if the calls are assigned. Decay characteristics. Time decay is mostly offset with this position because you're buying one and you're selling another. Max risk is limited to the current stock price minus the strike of the put, plus the net debit paid, or minus the net credit received. It sounds a little bit kind of difficult to understand there, but for the most part, it all depends on where your current stock price is versus the strike of the put and versus the amount of the net credit received, right? Because you're doing three different things, so these are three different things that you have to be concerned with. And we'll look at an example that makes it much more easier to understand. Max reward is capped to the credit received plus any potential gains from the share assignment. So again, it all depends on where you are long that stock from. The strategy here, use this strategy when you want to protect profits in the underlying ahead of earnings. Use this strategy to lower the cost of protecting profits. Use this strategy after you've enjoyed a profitable move and are okay with selling should the sold stock strike price be reached and assigned. And lastly, if you buy shares or contracts and at the same time sell the calls and buy the puts, this is going to be a buy right. So doing it all at the same time. Let's take a look here at an example. So right here, the objective of using a collar strategy is to protect a position in the underlying by buying puts ahead of news or earnings. Right? We have earnings in Blue Apron here coming up. Remember, we gap down in the example, or move down and then gap down. But you also want to sell calls to help offset the cost of the bought puts. But again, you must be okay with selling your position in the underlying if the calls are exercised. So in this scenario, again, say you got long 1,000 shares from $3, and you also bought the $3 put. Remember, the $3 put cost 30 cents. The $3 share price at 1,000 shares, that's 3,000. And then over here, you want to sell the $4 call. That's way up here. You're selling the $4 call, and you're selling it for 15 cents. So you see how this reduces your cost basis, because before we paid $300 for that protective put. But by selling the call for 15 cents, we're now paying only a net debit of 15 cents, which is all of $150. Your max risk is now 15 cents minus 313 minus $3 is $2, or 2 cents rather, which is basically $20 because of the way you've structured this trade. Incredible. The max reward is going to be $1 minus 15 cents. That's 85 cents. So again, if price were to go from 3 to 100, doesn't matter, you have to sell it at 4, right? If it goes to 3 to 450, again, you have to sell at 4. So from 3 to 4, that's your $1 gain. Minus the amount you paid for that trade, which is 15 cents. That's 85 cents, and again, you make 850 bucks max reward. So in this case right here, you are long shares the underlying from $3 a share. You want to protect the position by buying the $3 puts. They're slightly out of the money in this case. And then you also want to sell the out of the money call at the $4 strike in order to reduce your cost basis. Tips: buy a collar ahead of earnings, but look to buy the option 5 to 10 days ahead of earnings, as options will become more expensive as implied volatility increases the closer that earnings gets. Additionally, you can buy the underlying shares, buy the puts, and sell the calls all in one transaction to protect the underlying at the outset of the trade and to lower the cost. I love that approach. Again, if you're going to buy something, anything, you like this stock so much and you want to buy it, you want to be in for the long term, you want to be in for the next 6 months or maybe a year, this is a great way, again, to lower your costs and also protect yourself right away. Buy the protective put, sell a call out of the money. That will reduce your overall cost basis, but also protects you in the long run. So a great way to go. And again, you can definitely see this one again. Max risk is all of 20 bucks with the way that it's restructured here. And again, a great gain overall if price were to push into that $4 sold call. So let's take a look at the outcome now. This is the outcome. So the collar strategy offers a great way to protect a long position in the underlying ahead of news or earnings while looking to lower costs by selling the outer money call. Add the sold call to a protective put to create the collar when you are okay with selling your position in the underlying should the sold calls be exercised. So again, if you don't want to give up your trade, if you don't want to give up the shares in your underlying, then look to sell your call farther out of the money. Or don't look to sell the call at all, of course. But again, the farther out of the money, the less likelihood that price will reach that call and the less likelihood that you will be assigned and you can keep those shares. But again, this is a great way to reduce the risk ahead of time. So in this case right here, we have failed absorption, right? This is your rejection day candlestick right there. You have a rejection day trade sequence. Price closes below the mid, closes below the mid again, stop run day, a continuation. That's your failed absorption sequence, a major drop down, and then that all happened before earnings, and then earnings comes out and this thing gets beat again. So again, failed absorption here as price drops through the absorption zone, sells off ahead of earnings, and then gaps down on the earnings announcement, closing the week 84 cents below the $3 strike. By buying the put, you are able to offset most of the losses in the underlying, and by selling the $4 call, you are able to further offset the loss by receiving the credit. So remember, before, I think we made, what was it, 540 bucks on the put. And now, because we also additionally sold the call for 15 cents, we were actually able to add 150 to that, and now 690 is the amount we gained on that protective collar while losing 840 bucks on the actual share price of this underline. So again, you're able to mitigate that loss significantly by using this strategy. And again, the difference, 840 versus 690, is the 150 that you paid. A great way to offset the risk in a scenario like this. So tips: you can allow the $4 call to expire worthless and allow the put option to expire in the money and collect the gains to offset the decline in the underlying. So basically, allow them all to expire and collect those gains, and you can still be in your trade, if not even add to that position to lower your cost basis for the longer term move. You can choose to exercise the put at the $3 strike, which allows you to sell your 1,000 shares at $3 while collecting 15 cents on the sold call. That's another option. And if price were to have closed above $3, you can choose to allow the put option to expire worthless to avoid paying commission, but only the put because you bought the put. If you buy an option and it's out of the money, might as well let it expire worthless, not pay any commission on the back end. And again, there's always a chance something crazy happens and it would be back in the money. But if you sell an option, you definitely want to take that off the table if price is beyond it. Otherwise, if it's going to expire worthless, that's a good thing, and you get to retain the net credit. So again, a very solid way to protect an underlying position, especially for those of you who like to build longer term positions for your portfolio. So again, a collar is a great way to go. You can put this strategy on at the outset of a trade to reduce risk, but you're also going to cap your upside in this case. So you have to keep that in mind. And that concludes Step 3 Strategy Toolkit of our Swing Trade Pro 2.0 course, the 5-step swing trading blueprint. The strategy toolkit is one of the most important parts of the course in addition to the trade sequences. By putting all of these concepts together, you will have a very thorough toolkit to engaging any type of opportunity that you want to engage. Again, various strategies are more risky than others, and again, it depends on the probability of profitability for a given opportunity, whether you use which strategy or the other. So if you want to be very aggressive because you believe that the likelihood of that opportunity moving in your favor is high, then you can use something like in the money options or out of the money options to really take advantage of that opportunity. If you think the opportunity is good but has modest upside or modest downside, then again you can use a credit or debit spread for that opportunity. And again, neutral strategies are a great way to take advantage of markets that are range bound and either will remain range bound or will see significant expansion. So again, being able to understand when to use these strategies under the right circumstances takes experience, but again, it also helps reduce the risk overall because options, inherently speaking, with the way that we are engaging them, with the primary strategies in our toolkit, they're inherently going to protect your downside in most cases. So again, a very powerful portion of our course here. It may take several times for you to rewatch this step, but again, by understanding all of these various concepts, you're going to be much more well equipped to attack the market.